I'd like to call the meeting to order. I'll introduce the panel members first. Here we go. Do I have that on here? Yeah, I do. This morning, I'm Marcel Larondo. I'll be chairing. Robert Hutchins is coming to us via video. And Robert Upton is here to my left. Our assessor today will be Jeremy Pools. Our secretary today is Michelle Mabin. I'd like to begin by acknowledging that we are in Treaty 1 territory and the traditional homeland of the Métis Nation. To the participants of the hearing, please note that you are placed in a waiting room until your property is called upon. When it is your turn, you will be admitted into the meeting. Kindly follow along on the City of Winnipeg's Board of Revision YouTube channel for hearing process. Once the host admits you into the hearing, please close or mute your YouTube player. You will then be permitted to speak with respect to your property. Once your hearing has concluded, you can leave the meeting. We will be hearing applications for revision of assessment rules in accordance with the Municipal Act. The matters for which revision is requested have been described in each application, and we will limit discussions to those matters. The statements that are made at this hearing are sworn testimony. Anyone speaking to the matter must be sworn in. Be advised that comparisons of assessment of property are not considered evidence of market value by the Board of Revision. The Board of Revision is appointed annually by Council and is independent of it and the City Administration. It makes its decisions on the basis of the evidence provided and at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decision with respect to the application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or to the Court of Queen's Bench if the matter pertains to application of exemption from taxation. Should you wish to appeal, information on how to do so will be included with the board order. With respect to the hearing process, I will confirm the points of appeal with your property to be addressed with each applicant following the swearing in. We will then have the assessor's testimony followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all applications have been heard, and the board will deliberate in private and make its decisions. You will receive the board's decision by registered mail as soon as possible. As information, all public hearings are live streamed, recorded, and will be part of the public record. If I could ask you all to make sure your phones are also on silent, please. Michelle, are we going to start right at the top, or should we go to those two that are short? Let him get out of here.
I would suggest that we start at the beginning of the
beginning. Okay, that's the way we're doing it. File number 1 will be 220 Portage Avenue. Jeremy, you. Is that correct? 220 Portage?
Yes.
Yeah. Sworn in.
Yes.
Yeah,
just one
she's
moment,
going to do that
please.
in a minute.
Okay, Mr. Slaughter, I'll affirm you in before we get started. Can you state your full name, please?
Rod Slaughter.
Do you affirm that the evidence you're about to give at this hearing shall be the truth, the whole truth, and nothing but the truth?
Yes.
Thank you.
Jeremy, when you're ready.
Civic address is 220 Portage Avenue. Roll number is 120930155100. The assessed value for the 2022 year is $26,609,000. We turn to the back 2 pages of the brief. There's a border revision order. This was under appeal with myself for the 2020 year with Mr. Sid Story of Fairfax, who no longer represents this property owner. Follow-up appeal. Obviously, the years have been frozen. The order was reduced from 27,594,000 down to 26,609, which is the value that I'm recommending here today, just to confirm what was already done. So I'll go through the briefing for it now.
Am I doing something wrong? Did they change this all around or what? This isn't at all what I'm used to. Excuse me just 1 minute.
Sorry. So you're looking for this read?
Yeah.
That's the assessment brief. If you want it, you can summary.
Yeah.
Better?
Okay.
So, yeah.
Yeah, just,
Sorry. And then, yeah.
okay. And it just looked like the applicant's brief, so. Okay, go for it.
This is a downtown OFB building at Portage, Maine, just off Portage, Maine. It was built in 1965. We have an effective year of 1975. A gross floor area of 226,000 approximately square feet. Leasable area of approximately 170,000 square feet. On page 2 of my brief, it was purchased in 2013 with a sworn value of 41 million. There was 2 shared sales of half that. On the following pages are an outline of those those purchase sales. So this is straight off the Artist REIT's website. They're declaring what they purchased and what they purchased it for. You follow over to page 5 and 6. Sorry. Or on page 4, sorry, put out the highlighted under red is the weighted average cap rate. They declared it at 6.4%. So they're basically saying that that's what they purchased it for, their capitalization rate. And then on page 5 is just a documentation from their website as well, what they purchased it for. I used this sale for a capitalization rate analysis for appeal at the municipal board. Below is a workup for it. This is based on the items that we have leading up to their sale, not whatever they would purchase it for. Whatever they're going to, future income is going to be pulled back to what the present value would have been. So a little bit different analysis, but when I review it based on a stabilized income approach leading up to the sale date, you come up with about a 6% capitalization rate. They came in at 6.4. So following those pages are the INEs that those are based on. So we can see what they're coming in at. And that's just for fulsome review that if there's any issues with the incomes that were put on to the capitalization study that I did. So on page 13 is another review of what we have going on the property after the purchase. We see that there is a high income, or I should say a high vacancy, which sharply increases, and that's due to Great West Life leaving in the end of 2016. They occupied a large amount of the space of the property, approximately 100,000 square feet. And we can see that moving into a purchase, I would think that Artist REIT, given their knowledge of the marketplace, that they would confirm whether this property, whether this tenant in the property would be remaining and nail them down, or but solidify that income with the new lease, or whether they were going to leave. No knowledgeable property owner is going to be buying from property for 40 million, not knowing your one anchor tenant is going to be there or not going to be there. So as we can see, the building is performing well up until vacancy occurred. On page 14, we see that this is the standard working rent comparables that we've been using for the 2020 cycle. Highlighted in yellow are the CRUs that are at 220 Portage, the subject property. We can see that they're 16, 13, 17, 15, 15, 17, 15, 16. So they're above market. We see that the average rate for 71 comparables or CRUs is approximately $15. The weighted average is 14, and median is 14, so it's a pretty tight analysis, which you want to expect, which you want to see, for about 373,000 square feet. We see that below that, if we just segregate out subject property, they're in at 15.5, 1570, 1575 again. They're above market, and we see that. We see that the following page is just Cushman Wakefield of what their weighted average is. Their weighted average is about 1531, and that's for space that is available in the market. So following that is the Johnson report. We can see the 220 Portage. They're advertising about 48,000 square feet at $17 to get in a building. So, and that's in line with the, or I should say, it's in line, but at the higher range of the market. So, what we have under appeal, or what we have appealed today, is our income stream on the following page. We have an average of $12.86 for 177,770 square feet, which produces a potential rent of approximately 2.28 million. Our standard vacancy at 9%, expenses at 2%, and shortfall at 11, produces a net operating income of $1,862,606, capped at 6.75, gives us the original 27,594. And again, we are showing deference to the order that was given from the board, which is over at 26,609,000. I looked at this property a little closer. Obviously, I've yet to inspect the property. We had another assessor go through it for business assessment purposes. They canvassed the building to ensure that our records are correct. And when they went through, they indicated that a large portion of it, or at least the portion that she looked at, was renovated. So when I looked through it, if we can skip over to page 25, we'll just go over the subject property where it is. Obviously, 220 Portage, we know where Portage room. That's the building as it sits, the white one, right next to 360 Main. When we go through on page 29, after reviewing the purchase and the permits that were just in front of the purchase and afterwards, we have approximately 14 million-ish spent on the property for interior alterations, over 62 permits. Those are the larger permits. There's some smaller ones that aren't included in that, but those are the principal permits that are included. So they have been renovating the property. Go through to, skip past the line. Actually, we can go to page 47. We can see that for the RINE for the 2017 year, highlighted in yellow. We have their rent that they have highlighted in yellow at the top at about $15. We have the total occupied area of 81,000 square feet. We have a vacancy of 89,000 square feet. So we have approximately half the building being vacant.
Pardon me, you're saying page 47?
Yeah, page 47. It's just a summary of their.
Pages don't seem to be numbered here.
I know.
I'll wait till you catch up. Are you going from the Word document, or are you going from the
Word document?
Or the actual image of the document? There should, yeah,
Word.
you might get confused.
At Word, it ends at page 44. Then we go applicant's brief.
Assessor's brief?
We're on the assessor's brief,
So if I'm looking at,
page 44.
what I'm saying is my image of my brief has the picture, but it's
Oh, I
probably
see.
so small that you can't see it. So when you're looking for the, might be a problem going forward.
I'm trying to figure out which one's 47. That's all.
Everyone-
I'm trying to catch up with you too, so.
I'm into page,
I got 47 here now. There's numbered sideways on the page.
where was it?
47 is down the left bottom left that corner. It's sideways on the page. 47.
Yeah, it's landscapes. I'm just
You're
trying
better
to
than
catch
me.
up here.
These are lease charges. Page 47.
Yeah. I don't think the whole document's here.
Mm-hmm. I just go to 44 for some
Yeah,
reason.
sorry.
I got 47, we got lease charges.
What's the last, sorry, I'm just trying to catch up. What's the last page you have?
My last page is 44.
I've got 48, 49, 50.
That's same as you.
I just skipped ahead to this, to the agent's brief. I'm not sure why it's here.
I don't think it's you.
Nope, I'm looking at it right now. I don't know why it skipped ahead. I did the same thing. It just went automatically to the agent's brief. So
Yeah, and then you go further beyond the agent's brief, and then it's there.
I have it right now. So I'm looking at it.
Well, there's another.
Your document in the lower left corner will be in the Word document.
1 second here. I'll catch up.
The lower left corner.
I have to hit enable. I didn't even, it's right here. I don't know. See, my image numbers are so small, I can't read them.
Oh, it says page 50 of
50?
I did the same thing. As you're going through, just click and just goes there.
Yeah,
Is that what happens?
Yeah.
and then it's.
I've done it 3 times now. It's skipped ahead. I'm not skipping it. It goes ahead. So I don't know if it's because the document's so large.
Oh, okay, because I'm like, did I not insert
No, it's all there.
page?
Well, they've all got it. It's just me that doesn't have it.
41. We'll do it more
It is on
slowly.
page 50 though.
43, 44. That's where I am.
Page 50.
Well, that is too stupid. What is going on? Do you have a paper copy? Do you guys have it?
I just have mine.
No, on page 50, I've got tenant verification form. It says 50 in the corner down here.
Why is that? Why
On page 50, it should say rent roll lease charges. I'm looking at it right now.
You know what I'll do is I will
Shut us
just,
all down the road.
I'm just gonna send, I'm just gonna pop those
Is
pieces.
what you.
You're taking
But what
47.
I'm saying is, when I'm seeing it here, then it's-
There's 47.
Should be at that.
I can take a look. I don't want to come.
Rent roll.
Have a look.
All lease charges.
That's the one. That's the one he wants.
That's the one he wants?
Yeah.
You're way down the docket though. You're 325 Broadway. So if you come here to 220 Portage, it says brief. Should be page 50. Here it should be page 50. And it is here. But what I was doing is going here and it automatically jumps down so far that it just goes straight by
So it is there.
right there.
Okay, let's try again.
No, I think it's just that the document's so large in one Word document that if you just scroll and it just goes, shoots forward.
Thank you, Jeremy.
No problem, no problem. So we're all good?
No,
Yeah,
I'm
I
not
think
good.
so.
Whereabouts are you? Big what?
Page 50.
50.
I can go over and,
On 47 though, if you're done.
oh, my dog, yeah.
So that's where.
But it's so small on the image, you can't see 47.
Well, if you blow it up.
Yeah.
If you had it blown up, yeah.
I'm running on 2 pages at the same time because I would like to look at the paper copy.
So we're talking rent roll, lease charges, page 47.
So we're all good?
Yeah, I think so.
Okay, so, we can see in brackets at the top, it's $15 with the rental. You can see and below that is where I was getting at. the total area there, approximately half the building, a little bit more than half the building is vacant. On the following page, we see that they're declaring approximately 60% of the building as vacant. You see on the next page where it says rent income loss, they're attributing approximately 101,000 square feet at $15 at their rate, declared rate, and it's approximately 1.5 million for their vacancy loss. On the following pages are just the IMEs, which indicates on my brief, page 50, tenant verification form, and you can see the vacant spaces. Great West Life is still in there. We can see their end date as October 31st of 2016. So any space that was Great West Life is vacant. Getting to page 53 of my brief, where it shows Artist Reed's declaration of the property. 17-story building, obviously. They have a gross leasable area of approximately 169,000 square feet now, slightly less. We see that the building on page 54 has been renovated. They're showing a segment of the suites. Very modern, very above market. If you're looking at that, that is no longer an old, outdated building. At least what we're seeing. So we go through here, we see what Artist Reed's, just the following pages, who just what they're declaring, what has been done on the building. There's a write-up on it on my page 60. Page 62, the local amenities, and then on page 63 is the upgrades that occurred in 2017. They upgraded the building lighting in the system. They upgraded the HVAC in the spaces. They improved the fresh air, windows and window coverings. Obviously, they renovated the entrance, elevators, washrooms, and then they got a LEED Platinum certification, as well as exterior lighting. So they went through the building. Looks like they spent some significant money improving the building. Again, that's capital cost. We're not including that for assessment purposes. But when you do improve your CRUs and they attribute more rentable income, we do assess for that. So on page 67 of my brief, as we go through the pictures, we just skim through. We see here that they're declaring to get into the building now, it's $17 per square foot. $17 would be based on any renovated space. I'm sure there's some serious renovated, but didn't get $17. But from that,
Mr. Chairman,
Yes, Rod?
I believe that the document that Mr. Pohl is referring to would be clearly post-reference date.
I didn't see a date on it.
how would it be?
You'll see the estimated taxes and expenses are from 2019, so it'll be a 2019 or 2020 listing.
Is referencing 2017 improvements. Which page are you looking at?
He's looking at your page 67. It says
You'll see additional rent. In the middle of the page, you'll see the comments additional rent, and the amounts that they quote are from 2019.
That's where it says 2019 estimated?
Yeah, no, I'm there. This is straight off their website. Wasn't an actual document per se. But no, that estimate taxes would be post reference. Okay.
Thank you.
Again, we're talking the physical change as of January 1st, 2022. So that the renovations were to occur in 17 and onwards. So anyways, getting back to page 21 of my brief.
Back to 21?
Yes.
21?
Sorry, I had to go through a little
You
bit.
would do that.
I had to go through a bit of walking through it kind of thing. So when I'm looking at this property,
Just give me 1 second, will you? Yes,
when I'm looking at this property, we have approximately 177,000 square feet of leasable area. When I'm looking at a market prior to being renovated, whatever occurred, I'm not looking at contributing any rent today or any increase today based on that. If what I'm going to be recommending is we go back to the office place to send an inspector through, and if it is warranted of it, we'll release a supplementary. Again, for today's purposes, we're not going to be attributing any increase in rent to that. So I don't know how much of the space has been renovated. I'm assuming that quite a bit of it has, but that's an assumption that I'm not going to base correction for the assessment role now. We're going to have the what's under appeal now, and then review further once we get back. So when I'm going through this, we're looking at a $14 market, 9% normal vacancy, the normal standard parameters. It's going to go up a bit in rent. We come to a capitalization NOI approximately $2 million, which produces a $30 million assessment approximately. Below that, if I'm looking at this with what is experienced in the building, meaning they purchased the building, the tenant is gone, they are taking advantage of that vacancy, because vacancy is not necessarily a bad thing. If you're looking at a long-term objective of an investment vehicle, a large portion of your building being empty means you can renovate it and get current rents up, increase to rents that were otherwise old and outdated. So when we're looking at just the marketplace, approximately $14, same analysis, putting an increase to 13% vacancy, I think it's realistic. That vacancy you're not going to experience over the next 10 years, whatever you're going to experience it over a short-term gap, 2 years, 3 years before it normalizes. So when you capitalize all that out, we come to an assessed value a little bit lower at $27,669,000. That's pretty close to what we already have at the 26 million mark before we release. So I don't think there should be any correction there. I'm comfortable with the board for showing deference to the order. But if I'm looking at it based on what Artist REIT has declared to the property or the shareholders and to the general public, if they're looking at getting a $17 rent, this is on the following page, with a normalized market vacancy, even a bit below at 7, because A, they're dominating the marketplace there. They know the marketplace. They have a number of towers. They have 2 across, one 360 Main, 100 Peel Bay, one that was 153 North, which is also out drawn. But they're also putting up another office building. They know that marketplace. So when they release $17 to the public, I think that's fair. And when they release a capitalization rate at 6.4%, I also think that's relatively fair. So when you capitalize all that out and run the numbers again, they come approximately $41 million, which is exactly what they paid. So I think you're looking at a discounted cash flow, what they're going to put into a property, a projection. We don't deal with projections, we deal with facts of known at a reference date. I think what they're declaring is pretty much the sworn value which they purchased it for. So getting back to what we have under today, I think the $26,609,000 based on what was there, I think is reasonable, should be maintained today. And then we'll do a due diligence and go through the if there needs to be a revised assessment on those issues. So with that, I'm open to questions.
Rod, good questions.
I do. Thank you, Mr. Chairman. Mr. Pohl, right off the top, did I hear you say that based on permits and pictures, you feel that a supplementary assessment would be warranted for this building when the majority of improvements occurred in 2017? Is that what you said?
The majority of the improvements looks like it's, like I said, from the permits since purchase, they've improved the property. As far as the physical condition, that's out the current assessment year, which would be January 1st, 2020, January 1st, 2022. And it's not just based on the permits and the pictures that were on the website. It was also an inspector who went through for a business canvas of the building. A large majority of that building is no longer old and outdated space. So yes, I think it's more than wise to send an inspector through and review it properly.
Okay, so for equity purposes, is this going to happen every time an office tower has permits or work done? Because you guys will be very busy if that's the case.
Every time there's if it's one CRU, we're not going to go in and based on one CRU. This is not one CRU. This is a large renovation to a property, and a large renovation to the property. If it contributes to greater income, yes, we would be going through it, and we should be going through it.
Well, if the city decides to take that action, we'll cross that bridge when we get there. With reference to your presentation, Mr. Poole, if I can ask you to turn to page 2, and you had made mention in your presentation that there was a transaction in 2013 for 41 million.
Two shared sales, yes.
Okay, thank you. I was going to say on page 4, it's clear that this is a two. How do they word it? It's a two separate
sales. That's 21 or 20 and a half. No, sorry, you didn't make that clear enough. But yes, there's two sales.
Yeah, thank you. And you're aware of the IAAO's opinion on share transactions or partial transactions, that they should be excluded from as a valid transaction.
I'm aware of that, but again, they're given a sworn value. They're paying property taxes based on the sworn value, or I should say land transfer taxes based on the sworn value. I don't think this property owner, being knowledgeable enough to go to appeal and knowledgeable enough in the marketplace, wouldn't declare anything greater than what it actually is.
So has this sale price ever been used as a basis of the assessment by the city, or as a basis for value by the board?
Pardon me?
Has it ever been used as a basis of value by either the city assessing the property or by the board and deliberating the assessment of the property?
By the Board of Revision, I do not believe so. I've instead of municipal board for capitalization rates, as I indicated. But as far as us asking for 41 million under appeal, no.
Okay. And you agree that on page 2, there's also a transaction just 8 years previous at 17.5 million?
Right.
Okay, thank you. On page 16 and 17, you had made mention of rents by Cushman Wakefield and I believe the Johnson report. Just to be clear, and I think you said this, Mr. Poole, but these are asking rents, correct?
Yes, very good.
Okay, thank you. And on page 14 and 15 is a list of your actual Class B office rents.
Yes.
And this list does include main floor retail and restaurants, is that correct?
Shouldn't have any main floor bank spaces or retail involved at all of any kind.
No. Okay. And it does include suburban office rents as well.
There is a couple suburban OFBs in there for comparison. Yes.
Okay. Thank you. Now, the vacancy allowance applied, 9%. That is the standard market vacancy allowance applied to all Class B downtown office towers for the 2020 to 2022 assessment cycle. Is that correct?
Yes.
And on page 47, you had brought the board's attention to the actual rent roll and I believe the income submission. And it was clear that the actual vacancy leading up to the reference date was in fact 52%. Is that correct?
Yes, I believe it peaked at just about 60. Yes.
Is the actual vacancy, not the actual number, but the fact that there is a significant vacancy, you would agree that that is often considered in the valuation for an assessment by either the city or the board?
Yeah, what's actually going on in the property is always inclusive of you look at it, but you cross-reference it against the marketplace itself as well.
Okay, thank you. Now,
I'm sorry, Rod. Continue.
go ahead, Mr. Chairman.
Are you done, Rod?
No, I have a few more questions. Thank you.
Okay, go ahead.
Thanks. Mr. Poole, we had some discussion about the listing that you provided on page 67, if I can draw your attention to that. And I think you admitted that it likely was post-reference and, you know.
Well, the taxes would be yes.
Yeah. But you agree that even at this date, there's significant vacancy in the property?
There is vacancy, yes. Yeah, I mean, you have a large space that was vacant. It's a projection of what they have to finish. Some of that might be shell space waiting for tenancy.
Yeah, that's exactly, yeah.
I'm phrase it the right way. Just because you have a projection doesn't really make your actual projection. It might take a little longer. Obviously, COVID may have played into that too. But again, that vacancy that will be attributed now, that's post-reference, and anything COVID related would be post-reference. So we're looking at marketplace as of April 1st, 2018. So
Right. Yes, and that's exactly it. We're looking at the marketplace as of April 2018. We have a massive vacancy in the property, and you agree that one would expect it would take some time to correct that vacancy under normal circumstances.
yeah, and a knowledgeable buyer moving into it would know full well that that vacancy would be occurring or wouldn't be occurring based on the discussions they'd have with their main tenant occupying 60% of the building. It's not unexpected. And in this case here, knowing that Great West Life had a tendency to bounce around the marketplace at under market rents, wherever you go, they seem to be significantly under market from the building performance of other tenants in those buildings. You may not want Great West Life in there. You may give an opportunity to go in and review the property, improve the property, and then get better than market in or above market rents in. So vacancy is not always a scary thing. Sometimes it's quite an advantage thing.
Yeah, that would be very nice, yes, to make sure that you had.
Yes, you take advantage of it in that case, but it may take you a little longer to lease it up.
Yeah, thank you, Mr. Pohl. I think the last set of questions, page 13, if I can draw your attention and the board's attention to that. This was, I think, your analysis of the actual performance of the property in the years preceding the reference date,
Yes.
2014, 2017. And I believe what you're saying here is that, you know, let's not get too hung up on 2017. And we're both now saying, yeah, I mean, yes, this is a concern going forward. And this is what we would like to discuss in the appeal today. But what you're saying here is that, you know, if you look over the last 4 years, it's not always that bad. I mean, we have some years where it's better. And so you stabilize. And when you say stabilize, you mean average. Is that correct, over the 4 years?
Yeah, well, I mean, I got to look at you're looking at 4 years was a large vacancy, so you're not going to assume that 60%, 50% is like moving forward on an investment horizon, they're going to stay like that. The same way as if you look at 2012, 2013, and leading up to it, they are averaging about 1 or 2% vacancy for a number of years. Building was 100% basically leased up. So when you have a large anchor tenant, you run that risk. Just because they leave the building and lose a big hole in your insurance doesn't mean that you're going to take a little bit of a while to bounce back from that. You're playing an advantage when you have them in your building because you're now all of a sudden below market and you don't have to worry about market vacancy for a number of years over lease. But when they leave, that does leave a bit bigger of a hole.
Yeah, it's kind of like all the eggs in one basket is what you're saying. It presents.
Yeah, pretty much.
Yeah. Now, if we look at so we'll call it stabilized, or it's the average, and I see what you're saying. Let's not focus just on 17. Let's look back and get an idea of what history can tell us about the future. And so your analysis moves through the stabilized, and you come out with a net operating income at the bottom of 1.883. And I assume that is very close to the assessment NOI. So what you're saying is we're on track. We have a pretty good sense of what we're doing here for the assessment. Is that correct?
This was just looking at the raw numbers independent of the assessment, just the performance of the building, the 4 years leading up to the reference date. When I did the other 3 workups in Excel, this was independent from that. This is just let's take a look at what's going on in the building now with the actual vacancy. So those numbers may be close, but it wasn't. I'm using this one to justify that one.
Okay. Now, if we look though at some of the numbers. And again, we're averaging over those 4 years and trying to get a historical idea. But the third line item, if I can draw your attention to, it's storage rent or rent storage, I guess. It appears that might be a miscalculation in the stabilized column. Am I correct? I mean, it should probably be around 40,000. It looks like it's 240,000.
Yeah, sorry, my mistake. Yeah.
Yeah, no problem. I'm sure we'll find some errors in my presentation as well. That's fine. But the main point, Mr. Pohl, is that, you know, if we correct that and then we move through the same calculations that you're saying is a pretty good historical idea that we should use taking forward, that would then change your net operating income stabilized to $1,683,000. Is that correct?
Yeah, with that correction, yes.
Yeah. And you're aware that that's basically bang on with what Altus is suggesting today.
Yeah, but also Altus is also not using a rent that is at market. So
No, I think
my main
the point
concern-
is we're going about it different ways. I'm just saying it's kind of interesting that, if we correct your
my main
numbers.
look at this property here is, you look at it going back historically, it's hovered around 1-2% vacancy. It's been in the old state that it was. Now you have.
Yeah, that was a long time ago, not within the
Now you
last
have
5
an improved building, and from what it looks like, a majorly improved building that you would expect to get at least market vacancy at, or below it, or a little bit below it. And you have a group such as Argus Street, knowing the marketplace. They have 2 towers on the opposite side. They have 360 Main. They have 152 Lombard. They're putting up another tower. They know that marketplace. They dominate that marketplace in that block and around down Portage and Main. So when they're taking this property on and they know that there's a vacancy that's going to be or could be expected or they want, I don't think that putting a bit of a $14 rent on it and then taking a look at it the way we did is inappropriate. I think that's pretty much exactly what you should be looking at, a bit of a blip of vacancy, and you just have to basically know that this property would be an above what we rent. That would be a place and a marketplace that'd be for that. There's no right there, but yeah, I don't think the analysis that we have on it was unjustified at about 27 million for the border revision. Last go round, it was reduced to 26.6 million. I think it's okay given what was there. So the number that Altus is coming in with now, I don't know why, even though it's close to what the board ordered last time, why they would deviate from it as well. So.
Just to conclude that, Mr. Pohl, despite the actual performance at the reference date, despite the performance leading up to the reference date as indicated in the stabilized analysis, your opinion is that the property should be doing better.
My opinion is that market vacancy, if you look at that vacancy that's occurring, is not a projection that you think to continue. You think that this marketplace or that this market value for this property and performance of this property would be increasing significantly. So what we see here, I think you're at the low end of it. So I don't see the reason why we would.
And if you're correct, and we see that, correction in the vacancy escalation in the rents, then
You already see.
we would see that in the next assessment cycle. Is that correct?
You already see the increase in the rent.
Answer questions.
You already see the increase in the rents. Is what I'm saying. So.
Okay. I think that's all my questions, Mr. Chairman. Thank you.
Mr. Hutchins, you got any questions?
No, I'm good. Thank you, Mr. Chair.
Mr. Upton?
I think they've basically been answered for me right now. Thank you.
My one question I might get answered by the fellow after, but what page was that on where we had the
Stabilized.
on yours you're giving 9%, is that correct? You're using your value for the
On page 21, I think you're looking
yeah,
at.
you're using 9% for,
Yes.
and yet you're showing on the other page 35%
Correct. That's on the actual.
on the
Or
actual.
still stabilized because you're taking the years that before Great West Lake was starting to be cleared out.
Yeah.
So you're looking at an average of the years. So
But 2016 is when they left,
at the end of 2016,
and
October 31st.
and in 2018, which is the year of reference we're using, it was still vacant then.
Oh yes, yes.
So you're saying today's condition of the building,
Right. Taking back to that.
taken back to that, but we can't use today's vacancy, but you're saying it's still empty.
What I'm saying is you take the physical space as it is, and you move it back to the economic point of 2018. And then you look at those spaces what they are. And if I'm looking at those spaces what they are, they seem to be no longer dated lower CRU spaces. They are now what you see grade. So we would expect that those rents be higher than market, at least at the $14. But if you would think that it would be even higher than that, and the actual rental of the property in those spaces are getting that, you can be rest assured that those $15 to $17 rents aren't old spaces that are yet to be redone. Those are the new spaces.
Well, we don't know that. We can't use that information what the rents are beyond 2018, correct?
No, but those ones that I have my comparables are. So if you look at my comparables, page 14 and on page 15, you can just look at 15 if you like. You see those dates, they're end of 17, end of 16, and just the beginning of 16. So you see those spaces there leased up, and you guaranteed, I haven't been in those individual series, but you guarantee those aren't the old outdated spaces that are old outdated series leasing at $17, $16 rates. So when we see.
But we don't know that. We're making an assumption.
Yeah, but I think it's pretty safe that I think that the renovated spaces are leasing at a higher range.
But we are making an assumption.
So
Let's go on to your presentation, Rod.
Actually, Mr. Chair, could I ask a question arising, please?
Sure you can.
Okay, thank you. Mr. Pohl, in reference to that page 13 we're talking about, so just to understand, the large tenant moved out in 2016, 16, so we have a higher vacancy rate, but then the permits are taken out, and at that time is the $14 million spent on renovating those vacant suites possibly, or is it just?
Yeah, that's what it looks like. If you look on page 55.
Obviously, there's been upgrades to the lobby and,
They didn't just do this year. They went through the building. They took advantage of a large portion of the building vacant to upgrade it, obviously. And some of that space is still could be in shelled state. I'm not sure.
okay.
But the accessory or the inspector went through for the VA canvas, said a lot of it was just like we see here. So when you look at that, if you look at the permits that were taken out on my page, let me pick the right page here.
Yeah, we can see, we saw that it was renovated.
I put the dates in. So a large portion of that work was done right when Great West Light was leaving, right, or left. So,
Okay.
They're improving their income stream. And that's what you would think a REIT would do. An artist REIT, they're very well knowledgeable in the marketplace. You're going to take advantage of that.
All right, that's my only question. Thank you.
How much was that reflection on that page 13?
Sure.
Just we corrected the rent storage.
Approximately 200,000.
200,000 on the NOI, right?
Yeah, it would come straight off the NOI.
Okay. Thank you. Now, Rod, can we go to your presentation, please?
Yes, thank you, Mr. Chairman. I'd like to start by saying thank you to the panel for taking the time to hear this. And I know that two members of the panel had sat on the Board of Revision hearing for the 2020 assessment. And so, one might say, well, we're hearing this again. But I'd like to stress two things, Mr. Chairman. Number one, that as you're well aware, the court and board precedence is that there is a owner. The owner is allowed to appeal every single year. In fact, Motor Coach Court of Appeal decision said that each hearing, despite if it's been heard before within that assessment cycle, should be treated de novo based on the evidence before the panel in that hearing and not be bound to any previous decision. Now, in saying that, though, we don't want to be frivolous as consultants. This particular owner has asked us to review all of their properties in this difficult year that's, a frozen year, still based on a pre-pandemic market, although office has weathered that fairly well so far. But the point is, it's their responsibility to their stakeholders, to their tenants, to make sure that this large expense is appropriate. And to be fair, we reviewed every one of this client's properties, and we've done it in the way that Altus would approach a assessment value. And in most cases, we came to the conclusion that the assessments that had been revised before were fair, and that was our reporting. There were some cases, and this is one, where without any thought about what happened at the Board of Revision, our numbers came out different. So as step two to that, I thought, okay, well, let's make sure that we're not just going to the board with the same argument. And I went and reviewed at least the written submissions, and I found that while the previous agent I respect greatly and I think has a very good knowledge of these issues, it appeared that the approach of the argument focused more on one item of the expenses and the capitalization rate, actually. And I thought to myself that, I don't know if the property really was examined in the way that, at least in our opinion, we would hope it to be for this assessment date, for this reference date. And again, we're doing a fee simple analysis, but we're looking very closely at what's happening within the property. Now, I'm going to talk in a moment about our analysis that walks through what's happened up to the reference date. And I'd like to add that, yes, there have been renovations occurring through this property from 2015 to about 2017. That's the dates. And I'd like to say that I review many office properties. I've been involved in the appeals of most of the downtown office properties. I'm aware of the kind of work that has to occur for these properties to remain competitive, especially in what is happening at April 18, which is the market is moving to a tenant's market. We have a large, I'll talk about this in my analysis, but we have a large increase of supply in the market with a limited demand or a static demand, and that causes disruption. And when that happens, if you're going to stay afloat, you have to spend money. This is a common occurrence. Every single office tower in downtown Winnipeg has to spend money. And this money isn't just capital improvements, Mr. Chairman. When we go through what these permits are, and it's the same with every office tower, a great deal of them are the tenant improvements that occur. Tenant improvements that are necessary to attain the face rents that we're talking about. These face rents that reflect the current physical condition of the improvements that occurred in 15 to 17. If we do our analysis correctly, and we look at the rents that are being achieved and the market as of the reference date, and we account for the assumption that these improvements may increase the rents, but the rents being paid after 2017 are reflective of that. Everything else is speculation. And I'd suggest maybe not a realistic speculation, because the market has shifted. This is reality. Money has to be spent. It's in this environment, Mr. Chairman, that I find it very interesting that the allowance applied in the valuation of properties that reflects the amortized amount that the owner cannot recover, that they have to spend to attain and gain this income, that allowance has been eliminated of all times. When the market has shifted in this way, at least for office I'm speaking, that's when the non-recovered expense is taken out. So thank you again for allowing me to present through this analysis. And I do feel strongly that, we're here for a reason, and the owner would appreciate that this be treated as a de novo hearing. So if I can ask you to turn to our direct submission, it's 2022 Realty Assessment for 220 Portage, and it's not the rebuttal. It's about a 50-page document. And I'll just pause until everybody has a chance to have that in front of them.
We're there.
Okay, thank you. So I'm going to ask to skip ahead to page 10. The assessor has gone through the physical condition, and there's photographs and such. As he stated, the building is a Class B office tower. It's one of the oldest of the office towers downtown, not counting the heritage buildings, but it was built in 1965. So it's the first of all the ones of the Portage and Main. And it has had improvements, as every office tower does, through 2003. I think it was 2010, and again in 2017. And the effective date by the city has been moved up to 1975 to reflect the fact that, it's not completely a 1965 building. But I need to stress that buildings constructed at that time had certain characteristics or construction design that is not exactly up to date. You can't really fix that by tenant improvements and such. And so the owners do face a greater deal of expenses when they're trying to bring in new tenancies. You're all aware of the office tower. There's a few things about it. It's connected to the underground concourse. It relies upon the sister building that Artis also owns, 360 Main, for many amenities. For example, if the tenants in 220 Portage wish to have a conference, they would have to go across to 360 Portage to use the conference room there outside of the office. Fitness facility at 360 Main, the parkade that is under 360 Main, all of these things are not at 220 Portage, but they have to access them separately. The property had performed fairly well up until about the mid-2010s, when they, as Mr. Pohl said, they lost one major tenant, which was Great West Life, that occupied a great deal of space, and the Royal Bank, who occupied a great deal of space, downsized significantly. And that was about the time that Royal Bank actually moved across the street to the Class A building, 201 Portage. And this is what we're seeing happening starting in the late 2010s, especially up to the reference date, is what the market refers to a flight to quality. And it's really hitting the Class B market hard. If I can draw your attention, please, to page 13. Now, I touched upon this in the questioning, and I'd like to reiterate that the sale price obviously has never been a determinant used by the city as an evidence of market value, nor by the board, and there's a reason for that, Mr. Chairman. Number one, it is the product of two 50% transactions from two separate owners. The property was nearly, had a very high occupancy at the time. The owner did not know that Great West Life was going to leave. The sale was not subject to the open market. And in my opinion, and in interviewing the owner, it was a highly motivated sale. They're trying to, almost like in Monopoly, they're trying to have control of that corner of Winnipeg. And this office tower allowed them to have a substitute for tenants that might not wish to be in the Class A. So they paid a healthy price, they admit, but it was not a market transaction. It never has been considered a market transaction, and it shouldn't be today. And lastly, again, just 8 years previous, the actual sale price of the property was $17.5 million. And that has been used more as a barometer as we move through the assessment subsequent. On page 15, then, we begin our analysis, which is a fee simple analysis, but looking at the actual performance of the property. And if a transaction or a lease or anything else is considered at market, then we consider that to be within the basket of market evidence that we consider. And oftentimes, the activity in the subject property provides the best evidence of market for that space. Mr. Pohl had mentioned that the actual rents at the reference date range from, I think it was $13.80 up to $17 a square foot. But as I mentioned before, in order to get those face rents, the owner has to expend a great deal of money. As examples, two of the most recent leases had tenant improvement costs of $130 a square foot and $150 a square foot. The typical tenant improvement allowance in this property is $80 a square foot. That's money that they have to spend in order to get these face rents. The more you spend, the higher your face rent. So to use rents like that as a indicator of typical market would be misleading, because you haven't counted that to bring your base building space up to market, you still have to spend the money. Recent rents in the building include Unit 1304, which commenced in January 18. So this is reflecting, and this is what we were talking about earlier. The work that's gone in between 15 and 17, these new leases are signed with the knowledge that this work is coming or it has been done. And here's an example. 1304 was signed in January 2018 for $15 a square foot, right in the range that Mr. Pohl described. And yes, it is higher than the typical Class B market rent. But the point, Mr. Chairman, is if we're using the actual rents, then we are accounting for some of this work, which in my mind does not mean that you will have an escalation of rents at all. This is work that's necessary to maintain income. And the second example is 1101, and that commenced in October 2017 for $15 a square foot. These are two of the most recent leases up to the reference date. Now, I'd like to make a correction. On the rent roll, Mr. Chairman, some of the tenants, some of the smaller ones, it appeared didn't have a management recovery. And I deducted that in my analysis. But I found out that actually most do. Sometimes they just don't show as a separate line item. It doesn't change my value. It changes the value by 0.5%. That's it, because the deduction was so small. But I will cite my slightly revised value that corrects that deduction at the end. Now, let's look to the market then. What do we see happening in April of 2018? I'd like to quote from the Cushman-Wakefield report for Q1 2018. Landlords in the CBD will need to be aggressive as tenants pursue opportunities for superior quality space or more attractive leasing terms. The key factors in the decision-making process by tenants will be the leasehold improvement allowance and the commitment by landlords to undertake significant building upgrades. This is the norm. For some reason, this is being picked apart under this appeal, but this is the norm across the entire market. In particular, there will be increased pressure in the Class B market as a result of rise in vacancy rates in 240 Graham and 400 St. Mary. It's a result of the flight to quality that I referred to. It's a tenant's market, and owners have to spend money to keep these buildings occupied. Now, we look to market rents as well. Sorry, Mr. Chairman, I apologize. I have some rebuttal evidence, and at this point, do you mind if I submit that after my presentation?
Please do.
Okay, thank you. We have also looked to the market for comparisons in the Class B category downtown. And we have 15 leases. The first is 185 Carlton, and this lease for a smaller space is at $15.90 a square foot. The second is 363 Broadway, a very good comparison in my mind that underwent significant capital improvements to reclad the entire building. And this tenant is paying, as of January 18, $14 a square foot. Another very good comparison at the Portage and Main corner, 161 Portage Avenue East, built in 1971, but significantly renovated since. The tenant is paying $13 a square foot. The fourth comparison is a heritage building, 251 Portage Avenue, right across the street from the subject. $11.31 a square foot. I wouldn't suggest that's the best comparison. Nor would 433 Main, the next one, at $10 a square foot. Number 6 is back to 363 Broadway, $10.60 a square foot. Number 7 is a very good comparison, 330 Portage. Now this building has almost the same amount of capital and tenant improvements done over the same time period. Significantly renovated. But this is because it's an old building, and to compete with buildings like 363 Broadway or others, it needs to do these things. Despite these improvements, we have a tenant that's paying $13.91 a square foot. 317 Donald is a new building. This is the kind of competition these older buildings are up against. $13.85 a square foot. 386 Broadway, $14 a square foot. And there are a number of others that increase in size. But the point is, Mr. Chairman, when we look at the typical Class B market, and we recognize that a lot of these properties, you have to keep investing to keep up with. And the average that we come up with is fairly close, I believe, to what I'll get to that in my rebuttal. But our average is about $12 a square foot. So we have applied, unless there's a reason not to, if it's not deemed at market, we've applied the actual rents as our market rents in the subject property, with two exceptions, of course. One is the vacant space, which is at base building condition. And the second is for the owner-occupied space on floors 5, 6, 7, and 8. Now I'll pause for a moment. The property in 2016 had now lost or partially lost one and lost completely the other of the largest tenants, and the vacancy soared to over 50%. At that time, Artis made a decision to move their main offices from 360 Main over to 220 Portage. And part of that, I'm sure, was to alleviate some of the vacancy. Even knowing that that is coming, the vacancy still would be 28% at the reference date. But in a way, it's artificial. They did it themselves. They moved in to try and correct the trajectory that was happening. So, of course, as an owner-occupied space, we'll apply a market rent, as we will to the vacant space. And looking at the most recent rents, which again are reflective of the work going on in the building, looking to the market, but understanding that, as Mr. Pohl says, this might not be at this point a typical Class B, we apply $15, much higher than the averages, more in line with the actual new rents in the subject property, and not counting the tenant improvements that are necessary to get those face rents. $15 a square foot to the vacant space, which I think is very fair. And then on page 17, we go through the combination of market rents and actual rents for the subject property. And Mr. Chairman, this is where I think it's very important for the board to understand. In the last presentation for 2020 towards the board, there was no real attention to the effective income, neither the actual income nor the vacancy of the property. What we are suggesting to you is that we are applying a higher market rent than the city, significantly higher. Our average is $16.46. And that's reflecting these improvements. It's reflecting the fact that this property has some work done, whether or not we believe that that actually is going to change things. Because our basis is actual rent signed as of 2017. The city is applying $12.86, which is more in line with the market. So we are reflecting these things, Mr. Chairman. The difference is that we're also wanting to reflect the vacancy experience of this property. And should it, hopefully, as Mr. Pohl says, I mean, if the stars align the right way, maybe it'll correct itself. And we'll see that in the next assessment cycle. But for this cycle, let's talk about what's actually happening at the property. The last thing I'll mention before moving to vacancy, Mr. Chairman, is you'll notice a slight discrepancy in leasable area. The owner states in their submissions it's 170,000. If you add up their tenancies, 170,000. The city uses 177,000, and not that that's wrong. It's just that they include storage space. And what we've done is we've included the storage income as a lump sum, so it's not subject to vacancy or shortfall deductions. So it's 6 of one, half dozen the other, but that's the reason for the difference in the square footage area. Page 18, vacancy. The city has applied the standard market vacancy for Class OB of 9%. Every building would get 9% unless there are site-specific reasons to vary from that. This is a concept that is well established by the boards. And I'll quote from a decision, Mr. Chairman, the municipal board decision A02-382 concerns the 2002 assessment of a office building at 310 Donald. The actual vacancy at the reference date was 62%, very similar to what we're talking about now. And it did drop. By the end of that year, the owner expected it would be dropping down to 39%, and that was part of the deliberations in the board order. The city applied 25% vacancy allowance. And this is what often happens when there's high vacancy in an assessment cycle. The city often recognizes that. But the owner in this case said, no, that's not enough. The actual was at 39 and they wanted 35%. And the point is, it's rather parallel circumstances, but the board's decision ended up accepting 35%, but that's not my point. In making this finding, the board considered the subject property's actual vacancy experience. That's the main quote. And we see this again and again in board decisions. If the experience within that is leading up to the reference date is such that a higher vacancy allowance should be warranted, the city and the boards will often recognize that. So what is happening in the market? I mentioned it's turning to a tenants market. There's a flight to quality. There's pressure on Class B. Owners are spending more money. I'd like to quote another quote, and this has to do with from Cushman and Wakefield. They're talking about the Class A, but of course it's a trickle-down effect. And the reason for the increase in supply, which is causing this, is the pending completion of True North Square in the third quarter of 2018 continues to impact the downtown office market. And it goes on to talk about some of the tenants that are changing at 201, but it admits that this will create a large amount of contiguous vacant space. This is trickling through the market. At the subject property, the 2014 vacancy in the good times, when Great West Life and RBC were still in place, 15%. 2015, 15%. 2016, it rises to 59%. 2017, it's sustained at 52%. The owners then move in their space from 360 Main, and they still can only attain about a 24% vacancy. And I won't go into talking about post-reference here, but we have seen from a listing that this is not corrected despite all of the efforts. If we look to board decisions, board precedents, board language around these kind of issues, we look to what's happening in the market, we look to what's happening in the subject property. There's no way, Mr. Chairman, that the vacancy allowance should have stayed at 9% in this case. And it's not the board. The board didn't have the opportunity to deliberate this. It wasn't, as far as I'm concerned, brought up in the written evidence. But I ask today that especially if we're going to recognize the actual performance on the rental side, that we need to recognize the effect on the vacancy. And in this case, unlike the board decision where the city had applied 25% and the owner wanted 35%, I'm asking for 20%. But I think no less than that. The only other differences, Mr. Chairman, between the city and ourselves is Slight difference in the shortfall allowance. The city applies a market $11 a square foot. And again, we're looking to the actual performance in some ways as an indicator of market. The actual expenses for this property are closer to $14.35. So we've increased the shortfall slightly. That doesn't really make a huge difference. The next one is a big one, Mr. Chairman, and that is, and I alluded to this at the beginning, that in this environment, I am surprised that the assessment department has excluded the allowance that reflects the costs that are required to attain this income that we're applying in our analysis. And that specifically was called the 5% non-recovered management allowance. It was part of a total non-recovered expense allowance of 7%, which included the 2% structural reserve. Altus has prepared a lengthy submission on this, and I have that in evidence. I can direct your attention to that, or I can just hit upon the main points. It's up to you, Mr. Chairman.
Get on to the main points.
Thank you. Okay, so at the beginning of the discussion of this in 2020, there was a confusion. Is this a management expense? Is it not? I don't think that's even in discussion anymore. It's a non-recovered expense. What this really refers to, and it's established in appraisal text, it's established in other assessment methodology, is non-recovered expenses refer to any expense that the owner cannot recover from their tenants. And that includes space marketing costs, professional fees. It's different than the other two forms of unrecovered costs, which are structural reserve, still there in the 2%, and the shortfall that you don't attain on vacant units. That's all counted in the shortfall. This is specifically for space marketing costs, professional fees, those kind of costs which you can't recover, and again, are increasing significantly leading up to the reference date. It's deducted in appraisal methodology. It's deducted in other assessment methodology. It's a common deduction. It has been deducted in the City of Winnipeg assessment practices consistently up until 2020. We have done an analysis in our presentation where we've looked at 32 properties, and we see these expenses time and time again in different forms. They're sometimes above the line, they're sometimes below the line, they're sometimes mixed right in with the rental revenue. But in any effect, they're real costs that people recognize. And in our conclusion, just these management-related non-recovered expenses ranged from 7.35% to 11.76% in our analysis. But the point of that allowance is so that you don't have swings every time you have high vacancies in the property. They amortize it across the line. And it makes sense. And we are asking for that allowance to be applied again, because to take it out, especially at this time, we think is completely inappropriate facing the realities of the market. I could go on about that, Mr. Chairman, but I know I'm sure I've presented to each person on this panel many times.
I still remember last year, the year before.
Yeah. Okay. So in conclusion, there are four fundamental differences between our approach and the city's approach, and what I believe was presented to the board last time. And that is, we're increasing the market rents, but we're asking for a reality in the vacancy experience of this property. We're also asking at the same time that if we're recognizing actual vacancies and rents, that we increase the shortfall accordingly, and we ask for the inclusion once again of that 5%, very important 5% allowance. The last thing, Mr. Chairman, is that this board had wisely decided at last time on the value, again, based on the evidence before them, that really focused on capitalization rate. And the cap rate that was applied increased from the 6.75% of the city to 7%. I don't think it would be appropriate for me to come in today and say that I'd like to keep that 7% capitalization rate, because I'll be frank, in my analysis of this property, I would have applied 6.75%. And I will stand to that for my presentation. So I am actually reverting back to the lower capitalization rate applied by the city. I have no contention with their cap rate of 6.75%. Again, this is because I'm trying to recognize the realities and the risks of this property in the appropriate vacancy allowance. So, Mr. Chairman, with those four differences, you'll find our final value. Sorry, one more thing. I mentioned that we had a difference in leasable area. We're using the owner's leasable area, and that means that we're not counting the 7,000 square feet of storage, but I have included that income. In fact, in our way, we don't subject that income to the vacancy allowance, so it's a higher net. But that inclusion is the actual storage income, and it's in the city's brief as well. The discrepancy was on the stabilization of 45,733. So we're applying that lump sum after any vacancy and non-recovered deductions. So if we could please turn to page 26, thank you. We have our final conclusion. Now, the only difference from this to what I'd suggest to the board today is that, as I mentioned, I'm not going to make the small deduction on the management allowance. All that does is increase my income by 0.5%. The final value, Mr. Chairman, rather than the 24,602, I'd like you to just mark this down, please, would be 24,723,000. I can, Mr. Chairman, if you'd like, I can submit this calculation, but it's exactly the same. It just doesn't take away the management expense.
That's good right there.
Okay. So just to summarize, we've talked about why we did what we did and why I think it's appropriate and why it's different than what the board had considered in their deliberation of the 2020 assessment. But I'd like to bring you back to one last thing, that our net operating income is, revises to 1,666,000. And you will remember that number. That is almost exactly the number that the assessor calculates when corrected for the stabilized income of the property over 4 years. Coming at it different ways, but to the same conclusion. When we capitalize that income, Mr. Chairman, at the 6.75%, we come to the value of 24,723,000. The appendix, Mr. Chairman, is the same that Mr. Pole had. It goes through the income statements, which show the high vacancy, et cetera, et cetera. So I don't need to go through that. And I'll conclude my presentation, and I would like to just go to the rebuttal after questions. I will conclude my presentation asking the board to consider this revised valuation. And I thank you very much.
Do you want to do your rebuttal now or after questions? Is that what you said?
I could do it now because I'm sure some of the questions might blend between the two.
But let's do it now. You might have some questions.
Sure. Okay, so if you can please refer to the next document that we submitted, and it actually states rebuttal evidence.
I'm looking. I don't have anything for rebuttal evidence.
No, Michelle is the document that is sent Friday.
Yeah, it's not in the document folder, so trying to remember the document. And go to your folder, and it will be in there.
Okay, see it.
Where are you looking?
Mm-hmm. Go to rebuttal. Minimize your screen. Minimize the screen. That little thing on the top right-hand side where it's minimize, you know, the little takeaway mark.
Yeah, so right here.
Minimize, yeah.
Select the red bar where it says hearing evidence.
Right here?
Yeah. There. And then it'll say rebuttal.
Rebuttal?
Yeah.
Okay, got it.
Okay, let's go.
Thanks. So I'll just go through this quickly, Mr. Chairman. The permits that were included in the city's brief, and I've discussed the effect of those when we apply the rents that have applied. I've accounted for it, but I just want to be clear about this. These permits, we have the descriptions for. We also watch permits for all properties. Every single office tower has a long length of permits in this same time frame, and some very close to this amount, some much greater. Never before has there been discussion about a supplementary assessment being issued because of them. If we look at these permits, I have the descriptions here and the dates. Most of the improvements occur between 15 up to 2017. Over half of the permits listed are actually for tenant improvements. You'll see comments for frantic films, cosmetic improvements to the space. I mean, this is common. When we moved into our space, Mr. Chairman, the tenant improvement costs that were blended into our face rent were nearly, I think it was $75 a square foot. That was 10 years ago. $80 is typical. That's what everybody spends. In these cases, it reaches up to $130 or $150 in some cases. But I mean, let's not be confused here about these permits. These are typical permits that every property goes through, and not all of them are capital. many of them are for tenant improvements, over half in this case. This next thing I'd like to talk about is the city's rent comparisons that they show on page, I think it was 13 and 14. Now, I'd ask a question of the assessor about the city's rents. Yeah, it was 14 and 15. The rents that they were using to determine the market for the property, which again, we're applying something much higher anyway. But I asked, are these office rents or do they include any main floor space? And in fact, when I went through every single one of the rents, you'll see here on page 4 that anything in red is actually a main floor retail or restaurant. And I don't think that's appropriate in this case. The subject property doesn't even have main floor retail or restaurant, and we're talking about the office space anyway. So I've excluded those. I think it's appropriate to exclude those as I would the suburban office rents. And then when we exclude those, Mr. Chairman, you'll see that the average drops down to 1384 or 1239 as a median, which is closer, more in line with what we presented in our market evidence. So I just wanted to make that clear. And that's all the rebuttal. Thank you.
Okay, questions?
Okay, I kind of want to stick to brief as we go through it here. Let's get to the obvious. You're an agent for the owner, but you should know not to notice everything that the owner would know. How many of the actual about 30 CRUs, assuming that there's still 30 CRUs, have been renovated as of January 1st, 2020?
Any space that is occupied.
Pardon me?
Any space that is occupied would have had renovations. The vacant space mostly is in a base building condition.
Okay, so when we go through on page so it's clear. On page 55 of my brief, I noticed there wasn't a lot of pictures of the interior space in the brief. How many of the CRUs look like that one?
I'll have to just go back to your brief, page 55.
Is what I'm getting at. Like,
how many? I couldn't answer how many, Mr. Paul. I know many.
A better question would be, how many are in a base state that is ready to be improved to that space?
Well, it's differing degrees. It depends on what the tenant had asked for. So I've been through the building a number of times. Another one of our clients is in the building. I've been through this owner's space, and I've been through the vacant spaces for the inspection that occurred at the property. And I can suggest that what we're looking at here looks fairly similar to the space of another client of ours. It's nice, clean space. It's reflective of the rent that they're paying, or they wouldn't be paying that rent.
So the spaces that were under lease, old spaces, are they still unrenovated? Or did they move the tenancies throughout the building and start renovating all of the spaces? Meaning, if you were a tenant here and they were going through the building, they made you a new space renovated and moved your lease up to there? Or is it simply that the vacant space, the spaces that they wanted to renovate, they renovated it? Some remains unchanged.
There are some basic improvements that the owner has done to space, and when the space is vacant, they'll try and do those on mechanical and electrical, and you'll see that reflected in the permits. But the others, the descriptions in the permits kind of account for what has happened in each of one of the units, and it's par for the course for a Class A or B downtown office building.
So next, we get into that. You indicated that this is obviously an Artist Street-owned property, 360 Main is an Artist Street-owned property. You indicated that a large portion of the owner-occupied space transferred to this building, correct?
Yeah, in early 2018, they moved their head offices for both Artist and the related company Mara West over to floors 5 to 8.
And this building obviously doesn't generate income the same way that 360 Main is. You withdrew the repeal today, but for 360 Main, the 360 Main typically generates about $20 to $22 net. This is less
it attains a rent in the high teens in my experience, unless there's significant TIs.
I had a significant valuation done on 360 Main. It's there. Obviously, it's been withdrawn. We can't submit it, but I can tell you that the subject was performing just under $20, and a lot of leases were in place at $21, $22 that are newer leases. So if you're an owner or occupier in that building, you obviously don't want to be in that building anymore. You'd rather just shift to your next door building because that frees up space to get higher income. So it's more of a business move, a strategic move, and a good one.
Yeah, I mean, we could speculate on the reasons why, but the fact is that the subject property had a nearly 60% vacancy. And the owners, yeah, there's many prudent reasons why they might move over to 220 Portage, but one of those is that they wanted to mitigate that vacancy. They had CRA coming into the 360 main, and that was another reason. So to make room for CRA coming from 325 Broadway, they planned on moving to 220. So it's not the only reason, Mr. Pohl, but yeah, my point is that mitigation of vacancy was because of their own decision to move their offices in. It wasn't a market behavior.
I don't know about that. If you're getting $5 better on one building, you want to free up space in that. And my next question leading into that would be, is how much of the space that was renovated did the artistry move into? Meaning they renovated their space, what they wanted.
Yeah, they renovated their space. That's correct.
Next question leading up, and this is, I don't want to belabor this point because we did this a lot in 2020, for the 2020 cycle. You are including tenant inducements in your analysis, correct?
No. One of the things
you're allowing, typically with the municipal board is that we don't allow tenant inducements, tenant free rent, all that below line item. We don't include that for analysis for rent. We don't include it to lead to a marketplace value.
Yeah, so let me be clear about this, Mr. Pohl. You're exactly correct. I have not, or sorry, you're not correct. I have not included or considered a deduction for tenant improvements from the face rents. And that was the question.
You're them on the expenses.
Well, in the expenses, it's blended, and this is a great opportunity for me to speak about this, Mr. Pohl. Thank you. To answer your question, no, I do not deduct tenant improvements from the face rents that are applied. So if a face rent is $15 and I know it costs $150 to get that there, I don't deduct the amortization of $150. I applied the face rent. Now, where we recognize tenant improvement cost is part of many items which are included as the non-recovered expenses amortized as 5%. Now, what the boards had deliberated in the past was, the question posed to them was, we'd like you to take the face rents and take off the tenant inducements and come down to a lower net effective rent. In addition, the 5% allowance was being applied. And in the first case, the appellant withdrew their claim, probably because they realized, well, I'm double dipping. And in the second case, the board said, no, we're following the first decision, which is the Richardson board. We're not going to make a lump sum deduction. But let's be clear, that's not what we're doing here. And secondly, that 5% allowance was included in those cases. So to answer your question, no, I have not deducted.
I'm just pointing out to the board, and this is be obviously for a larger hearing later on from the municipal board. You're basically taking the same things they say you can't put on for the face rent, but deducting them off the expenses. It's a simple analysis where it comes off the expenses. And they, on every single order that I've read, says we do not use this to influence market value. So regardless if you put it in at the top or at the bottom, you're still using it to influence market value. You have any municipal board orders in your workup or in your rebuttal that indicate that they do use it to influence.
Every single municipal board order deducts the 5% allowance, Mr. Paul. Every single one.
You're now increasing the cost as you've done here, and I'll get to that. So I don't see anything in your order where it says we include tenant inducements or expenses of that nature to influence expenses or come to market value. I haven't seen that yet. So just to be clear.
Yeah, and I'd like to mention something else. We talked a lot about, and I think it's a very interesting correlation between our presentations, is your stabilized expense analysis. And I'd like to point out to the board that artists, when they provide their statements, do so by IFRS standards. And in doing so, they make the amortized deductions for the costs that are incurred for tenant inducements, leasing costs, etc. They make those deductions from the top line revenue, not even from above the line. It's from the revenue itself. And neither you nor I have included those deductions in that stabilized analysis, but they are real and they're reported in their public statements. I don't know how we can stand here today and say that we're just going to completely ignore this concept.
Well, gentlemen, I think you've debated that issue far enough. Okay.
Okay.
I don't think the two of you will ever.
We went for a whole few days. So, getting to your rents, on your page 16, you have approximately 15 comparables, of which 2/3 of them are greater than 10,000 square feet. How many CRUs are in there, and what are the spaces that are they more in line with 120,000, 85,000, 35,000, or how many are more in line with your typical, few thousand to 10,000 square foot floor plate?
Well, but the floor plate of the subject property is about 10,000 feet. Now, with the amount of vacant space, you may have a tenant take contiguous floors, or maybe even multiple floors not contiguous. We see that actually in the subject property. But typically, we're going to likely see leases that are under 10,000, which is why when I went through these, I was kind of focusing more on the first, I think up to about number 8 or 9.
So if you review and by chance, I now remember the presentation that you presented, my comparables, even though there's a few in there that may be arguable. If you simply review a number of the ones that are in my analysis that are typical 10,000 and under, your average and median do go up quite a bit.
Yeah, I'd like to remind you, Mr. Poole, that I'm higher than the market rate.
So if we go through to your comparables, after you've reviewed everything and you've put the vacant space in at $15, you come to 1646, correct? Mm-hmm. And then if we go over to your analysis, let's see here. I'm at page 26. That is the 1646 you're using?
I believe so, yes.
Okay, you then take your vacancy at 20%. There is a high degree of vacancy in this building. Granted, a major tenant left and they did renovation work on the property. Would one expect that with a better than average space, as we see on my page 55, if the majority of the building is like that, would you expect to see as a long-term investment horizon that 20% vacancy continue?
I would expect to see a high vacancy if I'm assuming that I'm going to get the rents that I'm applying here, which are above market. I would assume that it's going to take some time. I think you even mentioned that it'll take some time to correct the vacancy. And if I was buying this property in April 18 and I knew that it took the owner moving in to 4 floors of the space to mitigate a 59% vacancy, and I know what's happening in the market, then to apply these high rents, I would apply some risk. I could recognize that in the capitalization rate, or I would prefer to recognize it in the vacancy allowance, because then we isolate it to this assessment cycle. And as I said before, Mr. Poole, if the stars align and things greatly improve, we're going to see it in the 2023 assessment. That's when we'll correct it. But based on what we know today, I think 20% is actually conservative.
Okay. Just so we're clear on this, at around 20% or greater than that, my view and municipal board members that I consider that a chronic vacancy, meaning that's going to be withstanding and into the future. There's something about the property that barrier to marketplace, bringing marketplace into the property. Is there anything in this building after it's been renovated that would prevent a barrier to market coming in?
Well, in inspecting the property, the owner did make it clear to me that it costs them more to bring tenants into this building. They have a difficulty leasing in this building compared to many others in the market. And added to that, of course, is what I mentioned about the flight to quality. So rather than paying this kind of rent in this building, a lot of tenants will turn around and go to 201 Portage or 360 Main or one of those buildings. So they're having difficulty. It's real. And I don't want to talk post-reference here, but it's real. And part of this is because of the nature of the building. The fact it is, no matter how many times you fix it up, it's a 1965 building with the features that came with at the time in design. It doesn't have amenities directly attached to the building. It's not a big deal. I mean, you go across the 360 Main and the concourse, but these are all things that the owner has told me are difficult for them to lease. Everybody's having to up their game right now. Every single building. 330 Portage is another example. Actually, 330 Portage is an interesting one because they've spent almost the same amount of money. They had a 16% vacancy at the reference date, and the city applied 15%. I don't know why in this case everybody's ignoring the fact that this property is suffering.
If we can get back to your analysis, we've already talked about TIs, we've already talked about we don't include them. You are not off the face rent, but then you're taking off the expenses. If we look at shortfall at $14, that is above market. And it is the actual. Would you not be experiencing during a large scale renovation of the property a higher higher than normalized shortfall? You would expect. You'd have to.
I just simply looked at the actual shortfall in place. I didn't really do a market analysis on shortfall in this case.
So again, that would be one point that wouldn't continue forward in the future once the renovated spaces, which seems to be pretty much, I don't know if it's almost done or a little bit in shelled space.
Sorry, Mr. Paul. None of the costs would be reflected in that $14. That's just operating expenses and taxes. Anything that's improvements would be considered capital.
Okay. So
or part of the rents themselves.
Getting back to, and then we get below that line item to non-recoverable expenses at 5%. Really what it comes down to is, now that we're saying management isn't there, we went through that argument, was there. We're now basically coming down to what Altus's position is, that non-recoverable expenses are about 7%. You can call it structural reserve, you can call it just simply non-recoverable. We're giving to you're wanting 7. That's pretty much what the argument is going to be at the municipal board moving forward, right? And where you put it in, however you want to influence it on market value, whether it's going to be at the top end, at the rent, or the expenses. So, getting down to your capitalization rate, we see a building that has been renovated. There's no barriers to market. We see that the rents in place that they're getting contributing are between $15 and $17, which is a bit better than market. It's at Portage and Main. It's under good management. We see a vacancy at 20%, which, in my opinion, you would, if you're going to be putting 20% on, you better be looking at there's something chronically wrong with this building. Again, preventing market from coming in. You've elected to keep the capitalization rate at 6.75%, our standard parameter there. Capitalization rate is basically a sense of risk to the property. Given that there's no barrier to marketplace, I'm not sure why you put in a vacancy at 20%, but why have you not chosen to adjust the capitalization rate since you adjusted basically to a chronic vacancy? It doesn't make sense for you to use an above market rent, throw in a very above market vacancy for Portage and Main, and then not adjust.
Yeah, and I hope I made it clear why we've done what we've done as far as our approach, which is a fee simple approach, but recognizing the realities of the property. And in doing so, we've applied higher than market rents. It would be inappropriate for us to do that without recognizing the realities of the vacancy. I mean, I could have done a more market approach with a lower market rent and then perhaps a slightly lower vacancy rate, but that's not what we're doing. In doing that, I'm recognizing the risks in attaining those rents. And so I felt it was inappropriate to apply the current capitalization rate of 7%. And had I been doing this analysis with no knowledge of the previous decision, I would have felt that this property, if I'm recognizing all of these concerns that I mentioned in the vacancy allowance, I would keep the capitalization rate at market 6.75.
Okay. So getting back to the vacancy, which is a big issue here, we view it as market. You're looking at the actual, I get that. You're basing a lot of weight on 310 Donald. It's a 35% vacancy that they put on that municipal for that property. I've never seen that. I believe it's the only one I've ever seen at that rate. I reviewed a lot. I don't see anything above 25%, except for what this property here that was under appeal. I noticed you don't have the order attached to it. Right?
No, I don't.
Was there any barriers to marketplace? Is there any abnormalities with this building that would prevent a marketplace to be going in? That was taken into account.
I don't recall that.
Do you know what the rent rates were that they were speaking to?
Sorry?
Do you know what the rent rates were that they put in place?
I could find that if you wish. I don't have it in front of me, though.
One would assume that wouldn't be a Portage and Main location. It's off Portage and Main.
Correct.
North of Portage. Could it just be that this was simply an abnormal vacancy put on this building? It's just one order. Do we see multiple orders that you're presenting that are above 25%?
Above 25%, there's not many, but that's, again, the rate itself is not the point, Mr. Poole. The point is that this is the behavior that we've seen. The decisions from the board will recognize site-specific vacancy. I have another quote in our next presentation, if you'd like, from the municipal board on this exact item.
So when I'm looking at your analysis here, overall, it does appear that you're taking off tenant inducements you're using a large vacancy, which would then alter your market value to drop a bit below what the actual board order was last time. But you seem to be not accounting for the risk that would be and the vacancy rate that you would expect for a renovated property at Portage Main.
Well, I know what the vacancy is. I know what the realities are. And again, I'm not going to speak post-reference, but it would be pure speculation for me to think that if the stars align and everything's rosy, that we're going to improve this in a short term. If it improves down the road, we'll see it in future assessment cycles. The reality right now, what a potential purchaser would know in the market and in the property is reflected in my valuation.
And getting back to that, of the towers, the 5 or so towers that are owned by Artistry at Portage and Main or just off of Portage and Main, how many of them have anywhere near this level of vacancy? For market?
360 Main was suffering a great deal until they secured a deal with CRA, which we know about. 2 of the other buildings had large single tenants. Again, I'm not going to go past the reference date, but I can tell you that this is not a huge surprise. The market is changing.
To be very clear, I reviewed 360 Main in great detail, and I went through the building, including the CR space with a former agent.
You're talking about recently, though, I suppose, so that would be post, would it not?
No, this was leading up to the CR.
Leading up to
This was space that was reserved for a bidding process. It wasn't like it was sitting. They were trying to get the best kind of rent that they could get on the property. That's not the same.
So, Mr. Pohl, I've actually represented most of the downtown office towers at this point, and I could probably give you a list of all the vacancies. I can say that this is a reality in many buildings. 201 Portage was sitting at about 15%. 433 Main, another Class B, was sitting at, I can't remember even, it was 35% or something. In these cases, the boards would apply a higher vacancy allowance, as would be directed by the municipal board.
What I'm saying,
I could go on and on.
Your argument here is that where differentiates between myself and you and our point of views is that renovated space, which is already showing that it's going to achieve higher than market rents because it's renovated space at Portage and Main, will sit below or will sit with a large degree of vacancy into the future. And that's an assumption, correct?
I'm going by reality, Mr. Pohl, of what we know has happened at the property. Any speculation on the increase in rents that might be attained by the improvements from 15 to 17 are answered in the rents that we include in our analysis that are actual. And that also is reflecting the tenant inducements, of course, which is part of the permit cost. We're recognizing all these factors in the valuation.
All right, that's my main point, so I can summarize.
Mr. Hutchins?
Yes, thank you, Mr. Chair. Let's see, Mr. Slaughter. My first question, so the assessor has effective age of 1975. Would you agree with that? Current physical condition?
Yeah, I mean, sure.
Okay. It's now LEED certified as per the documentation presented. And that was part of the $14 million spent, I guess.
Well, they did some upgrades to their HVAC systems, which warranted that. I should point out, Mr. Hutchings, that almost all the Class B towers have some degree of awards for environmental improvements. But yes,
okay.
It is LEED.
And my next question is, I don't want to spend a lot of time on this. The purchase price. You stated that those are share transfers, are not actually of purchase price. Am I?
No, it was 2 50% shares. So there's 2 separate owners.
Okay.
And what Artist did is went to one owner and said, okay, buy the other's 50% share, whatever it is, and then we'll buy from you the property. So it was a combination of the 2 partial interests. And this is something the IAA itself has stated, that we have to be cautious when you're looking at, actually, they don't even say cautious, they say exclude partial interest sales as a valid transaction, because there are factors which could lead, when you take 2 halves, it might lead to something greater. Okay. That's a speculation, but the reason that they say be cautious is that could happen. The fact is, this wasn't exposed to open market.
Right. Okay. So Artist approached these owners because they owned the adjacent building. Was your information presented? So my question is, was there an appraisal done on the property at the time of purchase?
I'm not aware of that.
That you're aware of it. Okay.
I'm sure there was, but I'm not aware of
Yeah, fair enough. Okay, so you don't know, for instance, if they went to sell this property, they would have to establish a purchase price for capital gains calculations, right, if they resold it? So so obviously you're saying that those numbers that were registered aren't a valid representation of the purchase price. Is that fair?
That's correct, and I think that's established by the fact it's never before been considered as an evidence of value by the assessment department.
Yeah. Okay, so we don't really know what they paid for it. Is that fair?
We know it was two 50% transactions at 20.5 each, I think it was. That's what we know.
Okay, so 40 million.
41 is what, is what's on the record as the combination of two 50% partial interests.
Okay, so after everything we've heard today, the difference between your valuation or assessment and the assessors is about $1.88 million when it all comes down to it.
Approximately.
Under $2 million. Yeah, and that's because you're requesting a higher vacancy rate.
Higher market rent, higher vacancy allowance, higher shortfall, and the inclusion again of the 5%. Those are the fundamental.
Right. Okay. And a lot of what we've heard today is post-reference possibilities.
We've heard a lot about speculation today. Yeah.
Yes. Okay. The assessor's saying because of the renovations, there's potential for better rents. You're saying because of the vacancy rate, there's a problem with future tenancy vacancy.
I'm saying that I'm looking at the reality as of April 18, which is now the renovations have occurred between 15 and 17. We have a couple tenants moving in and paying rents that are being used in our analysis, and yet the property still has a vacancy concern. And that's something I don't think we should ignore.
Okay, so in your page 95, I believe it was, the vacancy rates, it showed it dropping to 24% in the first partial. Will go up to April 1st, right? So it dropped from in the 50s or close to 60 to 24 in 2018 before the reference date. I'm not sure if that's a full year of vacancy.
No, that's up to April 18. We can see from the post information submitted by the assessor that it continuing as one would expect. But what happened, Mr. Hutchings, is that from 59%, the owners then took floors 5 to 8. That brought the vacancy down as of April 18 to the 24%.
Yeah, but that's an advantage to them because they own the building. Then they can vacate wherever they were and save that rent and come into their owner-occupied space, right? So I guess that was a business decision is what I'm saying. But so that's reflected in 26% when they took over some of that. Okay, when they relocated. Okay.
Yeah, and that's exactly the point, Mr. Hutchings, is that it was a business decision. This isn't the market that corrected from 59% to 26%. It's a result of a business decision.
Yeah, okay. All right. I think that's all my questions. Thank you very much.
Thank you.
Yeah, I think we covered this pretty thoroughly. Just a minor point here, a question. You said your new requested amount was 24,723?
Correct.
And what was that? Why did that go down from 24,802? I missed that point.
Originally, Mr. Upton, when I examined the rent roll, and you can see this if you look to the rent roll in either submission, but some tenants will have listed their recoveries, taxes, utilities, management. And many of the newer ones didn't have management. And it only equates to about 47 cents a square foot. But I made that deduction from their face rent, assuming that they were, in slightly semi-gross. But in fact, after I submitted, I wanted to make sure about this. And I went back to Artis again and I said, is there a chance that maybe management's recovered, but it's just not shown in the rent roll? And they said, yeah, that sometimes happens. So I don't have an exact answer of which ones may or may not, but I thought it would be wise to simply drop that part of my deduction or my analysis and actually just apply the face rents in place. Now, because these were very small units and there's only a few, it made really no difference to the value. But that is the only difference between what you see in my brief at 26,602.
Yeah.
Sorry, 24,602, and what I just verbally said of 24,723. It's just simply not deducting.
Just a small point, and I clarified. Okay, thank you.
Thanks for asking.
And I've got no questions. Anything in summation? Go ahead.
I think we covered it all.
You're good? You're good?
Thank you.
Thank you, Rod. That'll conclude the matter on this one. We're going to take a small break. Okay, the next file up is 153 Lombard, right? No. 280 Main. And 280 Main, we're just going to adjourn that meeting. So we'll leave that one off. So let's go to number 3. So the next file up will be number 3. We have to bring back Rob.
So 235 Broadway.
Well, I find number 3 is not 325.
Hmm?
Back off.
I think we're on
agenda.
225.
Yes.
That's the navigation.
225 Broadway we're going to. Number 4.
That one.
No, this.
I got another piece of paper from Thank you. Okay,
No, that's all.
did you get it, Bob?
No, I'm not got it. Haven't got it yet.
Okay, we'll wait for you.
Trouble with the navigation bar here.
I think you got Gail there. Can't open the file?
Yeah, it's here. But it's, there. Okay, there you go.
Oh, now I got it.
Yeah.
How do you get that? Through navigation bar? Just-
Yeah, through navigation.
Okay.
Ready?
What are we doing to Main? We did, what are we doing now?
We're going 325 Broadway.
325 Broadway, okay.
You ready? Jeremy, when you're ready, you can start up.
Okay, good.
Yep, we're good.
Roll number is 12093361 civic address is 325 Broadway. The 2022 assessment is 50,347,000. My recommendation is to maintain that. I'll go through the property now. This one is new to appeal, so it wasn't in order prior. It was built in 1993. It was built for the CRA, which has since vacated the property. It's in empty now. The property is 6 stories. There is leasable area, 6 stories. Leasable area is 95,000 square feet. Gross area is 116,000 square feet. If we just skip to my page 12, I'll just show you some photos of the property. It's located on Broadway. There is a small parking lot adjacent to the property. It's on the rolls. It's there. It is currently for lease or developable. They're kind of figuring out what they're going to do with the property. It's run by Morgard. There is an underground parkade. You can see on page 14. I'll get into that in a bit. It is smaller, but I'll go into the actual building itself. We went through this property with Altus and Morgard. It's completely vacant, as you can see from the pictures. Pretty much what you would expect to see from a corporate head office type property. Majority of the spaces on each floor is just wide open spaces with a small amount of office spaces on the interior on the side a little bit until you get to, I believe it was the 4th floor, 5th floor. It had a little bit more, a little bit more management operating staff, but for executive, you want to call it, as you can see on page 24. But aside from that, it is basically, as you see on page 28, is the basement area. As you see, it's slab on grade. You can tell on the above, it's hollow core construction. This is a very well built building. When we went through it, sticks and stones of it is basically you can redo what you would want. Pretty much you can make a decision on whether you want to keep it office, if you want to change it to multifamily, if you want to change it to multi-tenant. I guess from what Morgan was saying, it's kind of up in the air. They're gonna rethink what they're gonna do, but the physical building itself is quite good. As you see on the next page, page 30 and 31, I had a question here with Morgard was, representative from Morgard was, why such a small parkade? If you look back on page 29 and 28, clearly to me, when I'm looking at it, like this could be a parkade throughout the whole basement. I was a little curious as to why they put up infill cylinder block wall, because you can take that down. It's from my explanation what they given, and clearly they built it just for the parkade that you see. It was due to the sensitivity of CRA, they couldn't control who would go in and out of the building. So by giving them a smaller parkade, you can control the security on the building. Fair enough, makes sense. But if you're going to redevelop the building, you'd have to put capital costs in, obviously, to convert the rest of the lower level into a parkade. But you could knock down that wall. Again, that's more of a cost renovation, but it's the option to, if you're going to redevelop the building, it's a nice option to have. So on page 33 is just a couple times 34. It's just a couple shots of the outside parking lot. So yeah, it does have parking, and if need be, they can develop it into quite a bit more parking. So we go through on page 40 of my brief. It is the actual income and expense questionnaire that was submitted. When we go through on page 40, highlighted in blue at the bottom corner, based on the leases that were in place for CRA, they were getting about 1.2 million, 1.23 million for net operating income. So now the building's vacant. What they're going to do with it in the future, if they're just going to renovate it for tenancies, I guess you can get a one tenant, head of corporate office of some kind to take up this size building would be nice. Or you could look at it converting it to one tenant per floor, or you'd have to put a little bit more into it. You're going to divide the floors up and lose some space for the municipal area, obviously, but that's kind of where it sits as is. When we're looking at it, I'm looking at it perspective that's treated as just as OFB until they actually change the use of the building. I'm not going to consider anything else, even though that kind of is the option. I'm not going to make any adjustments as this building really, it hasn't sat for long enough to where we would start taking some difference of approach to the valuation. So when we look, it's the same comparables that we used on page 3. We just talked about for OFB. Average is about $15, weighted average 14, median 14. Same comparisons as we see. 325 Broadway is after the Cushman Wakefield vacancy, which we already spoke to, being at approximately $15 for the vacancy. The vacant spaces, we listed at offer to rent. We see that on page 61, the subject property is also in there, 325 Broadway. 325 Broadway is in at approximately $14, which is almost virtually bang on with what our independent marketplace analysis is at. So as you can see, right in the market. And they were advertising this at 87,000 square feet of rentable area. So when we go over to the analysis, we have at page 6 for 87,000 square feet. And of course the basement area, which is at storage C6. We have $12.99 for the rentable area, at grade and above grade, which would be 13 approximately, $1 less than market. And then, although I don't have any comps, I don't think there's any issues with the $9 rate or so for the basement area. So with that, we produce a potential rent of 1.21 million for the 95,269 square feet at a typical 9% vacancy, which gives us a gross effective income of 1.1 million approximately. Expenses at 2%, shortfall at 11 gives us our net operating income of 985,000, which again is above the 1.2 which they were getting. So at 6.75% capped, we have a value of 14,593,000 for the building itself. And then the parking income stream side are as such, the 17 stall count, we have at $103 a square foot approximately. And the underground parking on the next page is at $38 a square foot. So with those two income streams, 35,000 and 469,000. We have a summation page on page 10, which is approximately 15,417,000. So today we have a value of 15,347. So it's a little off, but nothing that would change. So with that, I think it's fair. The only question is, how long will it take to lease up, and what's their plan for us? So with that, I'm open to questions.
Questions, Rod?
Thank you, Mr. Chairman. Mr. Poole, so you mentioned that this property, it was built to suit for CRA. It's a single occupant building. Is that correct?
Correct.
Okay. And we know that the lease that was in place from when they built to suit expired at the end of 2017, and then they renewed for 2 years. Is that correct?
Correct.
Yeah. And it was well known in the marketplace. We talked about this earlier, that CRA was moving to 360 Main. That was well known by the reference date. Correct? Yeah. So a potential purchaser in April 18 of this property knows that they are going to have a vacant building within 2 years.
Oh yeah, you wouldn't be buying it on the existing.
Yeah. And it's a single tenant building, I think 95,000 square feet, thereabouts. The comparisons you list on page 3. Do you feel any of these are applicable, considering that the subject property is a 95,000 square foot single occupant building?
Again, this is your OFB marketplace for the city, all encompassing. As far as whether this could be one tenant per floor, or you're going to lease it out altogether, or you're going to divvy it up and put up partition walls and create a multi-tenant environment with more costs, I can't say that. That would then lead to the smaller size CRUs being more applicable. But typically, you're not going to find within the 3-4 years leasing up to the reference date, 6 stories leased out to one tenant. So
That's pretty uncommon. But you'd agree it would require some investment to convert this to a multi-tenant design.
That would be capital cost put into it, because as they were indicating, they weren't even sure what they were doing with the building. The building itself, bare bones, is a good building, obviously. But whether they convert it to another use, or whether they continue forward with it, what it is, or whether they divvy up the space, I can't tell you. That's the ownership group to do that.
You're well aware of the Great West Life decision on 60 and 100 Osborne, in which the owner was arguing that the property, which was single occupant, should be valued as a multi-tenant building. And you recall what the board said?
Yes, very well.
The board said,
I attended one of the hearings, yes. Forward.
Yeah. And the board's conclusion was that if it's a single tenant building, it should be valued as such. We shouldn't speculate what it could be like as a multi-tenant building.
I should say leaseful area. You take out the mechanical area, you take out the vertical penetrations, you would try and do modified bone approach to be as if it were multi-tenant. Yes, I am aware. Yeah. So the point is, I guess, that there'd be quite a bit of speculation on how much leasable area would be eroded by the necessity of common areas and the costs that would be incurred. And in the end, the board said if it's a single tenant building, we'll value it as single tenant, I think. As it sits right now, that would be hard to speculate, because if they got a single tenant, great. But if they decided that they wanted 6 tenants or 3 tenants or whatever the case may be, you could lease out a floor-by-floor basis, and it would be a lot less cost to convert. It's kind of open in the air right now. Would you not agree with that? I mean, they were actually considering multi-family. they're actually considering what they were going to do with the building. I'm not sure they were aware of what to do with the building.
No, they have a different.
Paul, it'd be pretty hard.
Yeah, the point is, even to convert it to multi-tenants, like one per floor, they would have to have common areas on the main level. They would erode leasable area, and they'd have to expend costs. I think they also said that the exits would have to be connected to there have to be corridors leading to the staircases that aren't currently there, because it was designed as a single tenant building with the intent that people aren't supposed to really come in. It's a very high security special purpose building. So I guess in conclusion, Mr. Pohl, are any of your comparisons, or would you agree, sorry, that your comparison number 25 would be the only one close to the size of the subject property in its current physical condition?
If you're looking at it just as it sits now, yeah.
Yeah.
But I'm looking at it just as a typical office building downtown. The typical rates that it's being listed at was $14. Our market analysis was 14. That's close enough for myself.
Okay, that's all my questions. That's all the questions. Thank you.
Mr. Hutchins?
Yes, thank you. Mr. Pohl, when was the building vacated?
I believe they signed a temporary, like the problem explained, a temporary 2-year lease because they were waiting for the CRA space in 360 Main. I couldn't tell you exactly when, but I believe it was in 2018, 2019, 2019. It was like staggered, if I'm not mistaken.
I'm sorry, I can't hear you.
2018, 2019, I can't give you an exact date. Because a large space was waiting upon it for 360 Main. So.
Are you saying 2018, 2019? I can't hear you. Maybe you could lead forward, please.
All right. I can't tell you an exact date when they actually left, because my understanding was that the space was waited upon at 360 Main. So whenever that space was renovated and moved it into, so I can't give you an exact date, like if you're looking for that.
Approximate date.
Rod might know. Like I said, it was either 2018 or 2019.
Yeah, you're pretty close, Jeremy. Basically, the lease ended at the end of 17. They had to extend until the space at 360 Main was completed. So they were kind of moving out through those years.
Yeah,
it wasn't completely physically vacated until the end of 20, but they were kind of moving out from 18 on.
Okay, thank you very much. That's my only question.
Rob? Any questions?
Well, I'm sorry. Your question? You asked Rob?
No, you.
Okay. Your rent comparables are very small spaces. You're assuming this will be a multi-tenant building is the way it would finalize itself as to rental?
It would be very large, like head office, if you're going to get a 1 CRE tenant to come in. But I can't bring in several tenancies like that. They just don't exist.
You're speculating small spaces rather than say one tenant.
I'm just bringing in the marketplace that exists for OFBs, and then we're looking at it to put to this marketplace, or to this building. So I can't come in and give you a 95,000 CRE space in several of them. They just doesn't exist.
But you're saying it's not likely to be one tenant per floor. It's likely smaller spaces in this area.
The property manager that we're walking through, they were unsure what they were going to do with the building. It's new, so I mean.
Okay. Very good, thank you.
And I've got no questions. On with your presentation, Rod.
Thank you, Mr. Chairman. So I'll refer to the document 2022 realty assessment that's not labeled rebuttal. I do have some small rebuttal, but this is the direct evidence. And if I could ask, sorry?
You're doing your rebuttal now?
No, I'll do the rebuttal after, please, Mr. Chairman. I'll refer to the main document first.
Okay.
And as Mr. Pohl had mentioned, the two of us both inspected the property with the property manager, I guess about a month and a half ago or so. And I have photographs up to page 11, very similar to the assessor's photograph, so I won't spend much time on that. And Mr. Pohl has basically described the building in its current physical condition as it is. It's 100% vacant. It's now the previous occupant, CRA, has left. And I think it's important to know the timeline here, because we want to, if we're valuing this property as of April 18, based on how a potential purchaser would value the property, and based on their anticipation of future revenues and bringing it back to a present value, we have to know what happened in the timeline. The building was constructed back in 1991 based on a call, submission for proposal by the federal government for a very specific building for CRA. And it's been the subject, this property, of many board and court decisions. But one of the first board decisions, I'm just going to quote something that I think sums up the building quite well, and this comes from the assessor. That the assessor suggests that it is a unique building with features such as security throughout, limited access, special floor plate, larger than normal, specific storage, parking, including indoor stalls, and there are no other people allowed in this building. It is a building designed for a one-tenant occupancy requiring excellent security. And so this is the important thing. If I'm a potential purchaser buying this building in April 18, and I know that the CRA has now finished their lease, which was a built-to-suit lease for a very specific single-occupant building, and they are vacating. They're physically vacating from the reference date, and they will be completely gone in a short amount of time, and I have no revenue. Again, this goes back to that concept we talked about before. All the eggs are in one basket. How am I going to value this property? Do I think that we'll have another tenant that can occupy a single tenant building, nearly 100,000 square feet over 6 floors? Do I think that's going to happen fairly quickly? And what kind of rent will I attain for that? This is an example where an investor would be very nervous. And there are various ways that we can reflect this in the valuation. But certainly it has to be done on a market approach because the actual rent in place ends almost immediately. And that's exactly what the city has done, and I agree with that approach. But what we should not do, and this is in the direction of the municipal board for the Great West Life decision, is assume that this can easily be converted to multi-tenant without a consideration of the costs that would be incurred and the erosion to the leasable area. Now, in its design, this building was designed for high security, and one of the things that was pointed out to us in the inspection is that from the elevator core, there needs to be a separated access to the rear stairways. And that would be, again, a cost and an erosion to leasable area. If you had it, even if you hope to get one tenant per floor, you'd have to erode main floor leasable area for common area, expense and erosion of area. And so the municipal board had said, let's not speculate on these things. You know, what it is a single tenant building. So now we have a single tenant building designed for a specific purpose, 100% vacant in the market. If I can ask you please to turn to page 11. Well, I basically talked about the physical nature, Mr. Chairman, so I'll skip ahead and go right to our income approach analysis on this property. And I think the fundamental difference between the city's approach and ours has been now, asked by myself and I think Mr. Upton as well. Is it really appropriate to use those comparisons that the city had mentioned? And again, those include retail and main floor rent, restaurants and suburban, but in any event, mostly small sizes. Is that appropriate when we're looking at a building that's going to be 100,000 square feet to bring onto the market? And we're facing the same market conditions that I talked about earlier. Higher expenses being spent by owners to bring in tenants, a tenant's market, a flight to quality. I can tell you that this building would be considered very risky at its point in April 18. So what we did is we looked at comparisons again, like we did in the last one for Class B, but we're focusing now on the higher end of the range as far as areas are concerned. So in the last presentation, we focused on comparisons 1 to 8 at the bottom of page 15. Well, now we'd be talking about something that's much larger, whether it be single plate, but then again, the area should be eroded or more likely full area. So the last 3 are really the best comparisons. 2 on Carlton, very near the subject property, and the last on St. Mary, also fairly close to the subject property. Class B buildings, all of which are connected to the skywalks. The subject property is not. These rents are closer to $10 to $11 a square foot. This is reflecting a very important concept is the economies of scale. So in our mind, the city's market rent is excessive. I think the last comparison, actually, 444 St. Mary is a very interesting one. It's a Class B office tower with full underground parking, connection to the walkways and amenities. And the tenant paid $9.25 a square foot for 111,000 square feet over multiple floors. And then that stepped to $11.50 just after the reference date. $11.50 seems about appropriate. So when you look at space this large in the Class B market, you will have a slightly lower rent per square foot, notwithstanding the fact that this is not on the walkway system. Now, if we properly recognize an appropriate rent, then it would be, I don't want to speculate anything past that. So even though my gut reaction was that the market vacancy allowance is not appropriate in this case, it should be something higher because the building is going to be vacant in very short fashion. But I figured that if I'm recognizing this risk in the appropriate market rent, I won't be asking for a higher vacancy allowance. So we're applying the market 9%. In fact, we're applying market everything except, again, the non-recovered expenses. This especially is a building that will have to incur leasing commissions, tenant inducements, all sorts of non-recovered costs in order to get that kind of face rent that I mentioned. So this is another strong example of where I don't think this is the right or appropriate time to be excluding a very important expense allowance. So for the reasons that I described before, this should have the 5% included. And lastly, the capitalization rate. Again, I think if I am arguing about the risks in the market rent that I apply, I won't be veering from the market capitalization rate, and we accept the city's 6.75%. I do think, though, Mr. Chairman, that the cap rate of 4.5% on the parking lot is aggressive. In the last cycle, this property is applied 5% for the parking, and I've upped the cap rate on the parking to 5% on the surface and 7.5% on the parkade. Very minor adjustments, but that's the only place that I felt adjustment was required to the capitalization rate. So in conclusion, on page 26, there's really only two things that we're arguing here about this building that's going to be 100% vacant. Number one, as a single tenant building, we should be applying something that reflects the economies of scale and its site-specific features. That is, that it's not connected to the walkways. And secondly, that the non-recovered expense should be included in this valuation. And with those two adjustments and the slight bump on the cap rate for the parking, our value comes down to $12,515,000. That's on page 26. I don't think there's anything more to bring to the board's attention in the appendix.
On page 27. Oh, yeah, 26 and 27.
Yeah, sorry. Number of strings. I've quoted from the board decision, which I include at the end, where it talks that this is specifically a unique single tenant building. So that concludes my presentation. Thank you.
Jeremy, any questions?
Yeah, well, 1 second. I'm just a little curious, like, this is just obviously very old board order, but if you looked at page 60, your last order, or last page of the order, or brief, I should say, you have approximately $10 awarded and 10% for vacancy. We're slightly under vacancy 1% and $1.50 more that you're asking for marketplace. Obviously, it's a completely different marketplaces, but at the same time, commercial property has gone up significantly since then. It's not kind of funny that $10 was reasonable then, and you're only asking for $1.50 more. So if we turn to your page 16, it seems you're putting a lot of weight on the Great West Life lease. Is that where you're basing your rent from?
Partially. Yeah, I'm looking at current market rents for Class B space, reflecting a similar size.
But
so those are the comparisons.
So I went through Great West Life lots, and whenever I hear it, those clause, because wherever they go in, they get considerably lower than marketplace in that building that they're occupying. So we've looked at 444 St. Mary's in quite detail. We're obviously heading to investment board order on this lease at Great West Life. Did you look at the way the rest of the building was conforming for 444 St. Mary's? To see what the average is?
Yeah, I don't have it in front of me, but I could open up that valuation.
13, 15, 14?
Yeah, for smaller spaces, though, that's the point.
But the rest of if you look at the global performance of the building, they're around there, and they're coming in, I believe, quite a bit less than that. So I don't think that Great West Life is ever a good rent to use, because pretty much wherever they go, they seem to either be, and this is the essence of a large lease that it's going to come up. They're either tremendous negotiators, and they can convince property owners to give them a lot better deal than other CRUs that are being leased out in the building, or there's something in the leases. Have you looked at the leases in place? Have you examined the Great West Life lease?
I don't have it in front of me, Mr. Poole. I know one thing is that there's less tenant inducements involved. Great West will often take space more in its current physical condition, which is exactly, I think, a great comparison to what the subject property would be like. Because again, in order to get higher rents, you have to spend more money. And so when we have a building like the subject property, 100% vacant, single tenant, unique design, I think this is a great comparison.
So just to get into Great West Life a little bit further, and we can tie it back to 220 Portage, because the analysis that I looked at back, they were a long time tenant in there. They took over from Agricor. There was a municipal board order on a 220 Portage where they kicked out Great West Life's lease because it wasn't at market. It was challenged from the municipal board and Court of Appeal. Court of Appeal said no, municipal board is okay. They can kick it out, and then they continued on with the next series of appeal. Basically, what we discovered is from Great West Life is they go in and they pay for the space. So that happened at 220 Portage. Do you know if this happened here as well? 444 St. Mary's? And when they occupy the space, they go in and they pay for everything, which pull back their rent.
No, I don't. But I just want to be clear, though, Mr. Paul. There's two St. Mary's in my comparisons on the bottom of page 15.
444 St. Mary's.
Yeah, and that's the one at number 12 in the comparisons. And then there's another St. Mary at the bottom at $11 a square foot, which is even more space. That's 333 St. Mary. I just want to make sure that.
You're looking at page 16, you have underlined midway through the page 444 St. Mary's.
Yeah, and that's right. And that's the.
It appears both at this property and at 220 Portage that Great West Life paid for their entire renovation of the space that they occupied.
Right. But just to be clear, that's only one. That's only one comparison I'm looking at. Eh? Like I
contacted Great West Life and they indicated as such back to me. So they're paying total cost, which would be significantly less risk to the property owner when they have to pay that cost and then anticipate them including the waste or whatever the case may be if they left. So I don't think this is a good analysis as far to include this as far as analysis.
Yeah, I'll just say this, Mr. Poole, that I do think this is a very valid comparison for a large contiguous or a multi-floor space being occupied. It's not the only one I'm using, though, to be clear. That's one comparison. There's 4 others that I'm listing within the comparison.
So you're aware of the argument that's going to be presented. I thought you might have been aware of it by now, considering we have legal involved and it's coming up about a month and a half from now.
Yeah, that'll be a big decision. I agree.
So getting back to Morguard. Morguard, did you not agree that they are a very wise property management firm?
Sorry, they're a what?
They're a very wise property management firm. They know market price. Absolutely.
Yep. Yes.
I looked through their INE's lots and they report very well. They know what the marketplace is. So did they list this space at $14 to market? And that's what's showing on the Johnson report.
Possibly, yeah. They've been trying to do something with the building, occupy it, sell it. I mean, I could talk about post-reference information, which I won't, but I'll say that I am very high in what my estimation is.
Johnson report's not post-reference.
Yeah, it's an asking rent, though, Mr. Poole. Like the fact is, they have not had any interest.
So similar to Artis Reed, similar to Morguard, they're very knowledgeable property management firms. They know what the marketplace is. So when they're asking for $14, that's a pretty good relationship to what they expect to get.
No, I wouldn't suggest that. And asking rent isn't ideal. It doesn't mean that they're not knowledgeable players to be asking for what they'd like to see happen, but there are realities. I mean, that's what I'm trying to focus on in both of these presentations is the realities. There's a lot of speculation. We'd love to get they would love to get $14 a square foot. It's not happening.
So,
and I'm describing why it wouldn't happen, because I'm showing you that when you have a large building designed specifically for a single tenant, 100% vacant on the market, you're not going to get those kind of rents that you do for 5,000, 10,000 square foot units.
all the questions I have.
Mr. Hutchings?
No questions, thank you.
Robert?
No, none at this time, thank you.
None at this time. Anything in conclusion?
Oh, it's awful.
Anything for you, Rod? Nothing?
Oh, thank you.
That'll wrap this one up. Let's move on to the file number 5, which will be 301 360 Main. Is that?
No, that was
That's withdrawn?
So we're at 286 Fred.
286, okay. That's number 6.
286 Stratford.
Yeah, 286 Stadbrook. Rob, you got it?
Yes.
Mr. Ruffin? Found it?
I've got it. 286 Stratford?
Yeah.
Good.
Okay, let's go ahead.
Roll number is 120317020000, 286 Stratford, specific address. For the 2022 assessment, we have $938,000. The property was built in 2017. It's fairly new. 2 stories. We look at, we should probably just skip ahead. There's a gross floor area of just under 5,000 square feet and leasable area of approximately 4,000 square feet. We skip ahead to the property on page 8, highlighted in red. Page 9 shows elevation views, and 10 as well. Page 11 is the permit that we found. It's to construct a 2-story medical office building. Approximate projection of the value for cost anyway, so it was $600,000 approximately. Obviously not including lot was already purchased on top of that. Next page over is a listing, $16 a square foot for a second story space. As you can see, the listing follows suit. It's just straight off. So when we go through this, looks like it's an OF, and this is new. Like this is the first time I've looked at this property. So looks like it is a office medical building, basically 2 stories. So what we have is basically an OFS analysis on it. So I'll get to that in a second, but the comparables are on page 40, or sorry, comparables are on page 3. Page 3 has 46 comparables. These are all office medical. It hovers around $17 average and weighted average with a median of $15. When we go over to the next page, we have just an OFS rent, or I should say an OFS workup. And again, that's okay.
We're just dealing with liability and class on this one, right?
Yeah. So I'll get to that in a second. So this was kind of new, obviously, to appeal. We're looking at it. We have a main floor rent of $20, and then second floor rent of $19, and a basement area lease rate of around $11. So for the 4,000 square feet, we're getting a potential rent of $67,170, vacancy at 5.5. Effective gross income gives $63,476, and with our standard parameters at 2% for expenses and shortfall at 7, gives us a net operating income of $60,666, capped at 5.55%. Given the size and nature of the property, it's going to be the lower cap rate. We produce the value of $1 million, and then we have adjust that down to 933. When I'm looking at this property, given we get back to the pictures, stick frame construction, office medical, obviously, main floor, waiting for office medical, second floor, an OFS. Okay, we had it in here. If we put an OFM in there, it would be a higher value. I'm not going to put an OFM in there. I'm going to leave it at OFS. And mainly, I'm looking at what the property is. It does appear to be an OFS, or so OFM. There's some issues with the second floor that I'll let the tax agent get to. But given the physical nature of the building, where it's located, I think $938,000 is reasonable, and that what they can get around that. Whether it be retail, whether it be OFM, whether it be OFS, that's roughly what we can get for in that area. So I think it's reasonable as such. I'll leave it open to Rod's questions.
Rod?
Thank you, Mr. Chairman. Yes, thank you, Mr. Pohl. So the comparisons shown on page 3, these are all OFM or medical offices, correct?
Correct.
Yeah.
And
So they're being.
Sorry, go ahead. And that was chosen based on the use of the property, based on what we found for the permits. So.
Okay, so but these comparisons, which average they have a median of 15, average $17, they're being used as the basis of the valuation. And on page 4, you've applied just over $20 to the main floor of the subject, and just under $20 to the second floor of the subject.
Yeah, that's correct.
Okay.
It's not so much just the comparison of the rent, is what is the property is as such. Obviously, there's a part of discovery to every appeal. So when I'm looking at it, a higher end rent, that's what it should be. But given the physical space of the second floor, it seems like this is a project that's stalled.
Yeah, but you bring a good point. I mean, we look to market, but we also have to consider the site-specific features. And you'd agree that the subject property doesn't have anywhere near the parking that any of the comparisons as offices or retail establishments would have, correct?
No, there's limited parking on site, but there's plenty of parking out front. Given the use of the property, you wouldn't think that parking would be an issue.
And the property is, well, sorry, actually, on page 14, you referred to the listing.
Sorry, can you repeat that?
Sorry, on page 14, you referred to a listing for the property?
Yep.
Yeah.
Starting at page 12.
Yeah, and so we see that they're listing it for $16 a square foot, correct? That's much less than what you're applying.
Yeah, but that's also in an unfinished state, right? I don't have what we don't have in what the actual lease would be in place, how much the tenant would have to cover, if anything.
But of course,
all I see is what I see, and as well as what you see. So it looks like it's shelf space waiting to be developed.
Yeah, and exactly what I've been talking about all morning is that it costs something to get a tenant into this to fix the space up. You can see at the bottom of the listing, they say tenant improvement allowance to be negotiated. So that's going to be part of the.
And if the tenant covers all the costs, maybe it's 16. And if the property owner covers all the costs, it's probably higher, but $3 higher than 16. So
well, we could speculate. Usually, the $16 asking is inclusive of some degree of tenant.
That's what I believe in it as such. So
yeah. Now, you're aware, or you have on page 1, that the property is zoned RMFM, correct?
Correct.
Residential zoning. And by the zoning bylaws, are commercial uses even permitted in this type of zoning?
With the variance, I would assume so, yeah.
With a variance, exactly. It would be a very
Obviously, it's being developed as such, that must have been achieved.
Yeah, but the point is typically RMFM would not be permitted to have office or retail occupancy. So you would require some sort of variance.
Agreed, yeah.
Yeah, and you'd agree though that if you had a variance for a specific use, that other uses might not be allowed or would not be allowed. Would you agree that that would have a detrimental effect on the potential rent that the property could attain?
Yeah, it all depends on what the use would be, right?
Well, if you can't have, for example, typical office, or you mentioned suburban office examples, if you can't have that as a tenant, your market is extremely limited. So would that be reflected in the valuation?
Well, it would all depend on where the location of the property is. Clearly, it's on the corner, and this variance was granted. If you're stating that this can be converted to an office or a different type of use, that variance would have to be reapplied for, given that it's already as such changed from medical, what it is now, or trying to be developed into now, into a regular office type. I don't think it would be much of an issue.
Yeah, I'll talk about that in my direct evidence, actually. So, last question: you've applied a capital.
This may block around a number of other type of properties where it would be completely out of line. For systematic location, it's for a multi-family property. It's on the corner. I don't think it would affect anyone's property value if they change use of the property. And such, various probably.
Yeah, I'm not sure if I caught that, but that's okay. I'll address some of those items maybe in the direct. But last question: On page 6, you show excerpts from different marketing reports by different brokers. Certainly shouldn't be given 100% weight, but they give an indication of cap rates. And Colliers, CBRE, Cushman, Wakefield, they all have cap rates for office, suburban office, between 6.5 and 7.5%, correct?
Correct.
Yes.
Yes.
And the subject property has been applied 5.55%.
Yeah, due to the size of the building, you'd have more of a marketplace for it. More people can attribute to buy something like this versus a large scale investment property or greater than. So you have more competition and supply demand. It will lead to a lower cap rate.
Okay, that's all the questions. Thank you.
Mr. Hudson?
Yes, thank you. Mr. Poole, what is the zoning on this property?
Front page would be multifamily.
So it's residential, but there was a variance obviously given to be able to construct this medical office, is that right?
Correct, and I didn't research the variance. I mean, clearly it's being built, it was granted by definition it's there.
Okay. Okay, that's my only question. Thank you very much.
No questions, thank you.
And I've got no questions. We're just gonna take a minute here. We're gonna have to reboot, close the files and open them up again. Are you ready now, or do you need some more time yet, or? Okay, go ahead. We'll wait 30 seconds. You go ahead. It'll be 30 seconds. Yeah, go ahead.
I do not.
Yeah, stop it, please. We're just gonna take a little break here. We gotta change some stuff around. Won't be long. You're back up. Call the meeting back to order. Rod, if you can present yours.
Thank you, Mr. Chairman. I have a little bit of rebuttal, but I'll start with the direct evidence. And I'll just talk a little bit about the property, Mr. Chairman, and there's some photographs you can refer to on pages 8 through 11. I'll walk through those as I discuss. So, as Mr. Poole had mentioned, the owner constructed this building in 2017, and in order to do so, they had to first obtain a variance from City Council, allowing them to have a conditional or a variant use of a clinic, massage clinic. So it's being used for a massage clinic on the main floor. They obtained that. The city was strict, though, that it would be only for clinic purposes, medical purposes. And the zoning requirements actually stated that 10 vehicles, there had to be 10 stalls, sorry, for 10 vehicles. And they made an exception in this case. They said, well, you can reduce it to 6. And she actually has 5 plus a small area, maybe a motorcycle could fit. But they still passed it, but with the strict requirement that it can't be used for anything else commercially outside of residential uses, except for clinic. So they went ahead and constructed the building. There's a main floor. You can see in the pictures on page 9. You come in, there's a small reception area, and then there's a hallway with a number of small rooms that she can use, or perhaps somebody could lease out just on a kind of a per room basis and then share the cost of everything else. And she hasn't really had any tenancies. Same thing in the basement, although she hasn't finished a lot. You can see the picture in the basement. It's similar to the main floor, except that many of the rooms aren't even finished at this point. Nobody's really occupying it, and there's very little fenestration in the basement. And then the second floor was unfinished, hoping to get an occupant. There is no elevator. There's only 2 staircases, one at the front and one at the rear. And they've had this on the market for some time. Graham Roswell is their agent. You can see the listing. And he was the one that approached me actually saying, this owner, my client, is in trouble. And their taxes are high and they can't get a tenant in the building. And I asked a lot of questions. He said, well, the main thing is that the variance only allows for a medical use. So they don't even have demand for massage masseuses on the main level. There's nobody interested in going upstairs. So they've been trying to market it as office, but they can't because they don't have the permission. It's not zoned or it doesn't have the allowance as such. So people have come along and said, well, maybe I'll rent it for X amount, but they can't do it because they want it for an office. So it sat vacant for all this time. This summer, the owner, she has an apartment on Henderson, she mentioned, but she gave that up because she can't afford that and this clinic that she's having difficulty with, and moved in to the second floor. It's zoned residential. So she actually occupies the second floor space. You can see that on page 11. So she put in a small kitchen area, she's got a fridge, sink, et cetera, and she lives there now. So interesting concept then to value this property. So what we've done is, number one, I said, okay, never mind the value of the building, or at least the income potential for the main floor and the basement. If you're occupying the second floor, you should be classified as such. So I refer to the classification of property and portion values regulation. On page 13, I have this excerpt that the class known as residential 1 is the class of property known as residential 1 consists of the following. And one of the first item actually is a building or portion of a building that is used or where unoccupied is designed to be used solely as a dwelling unit for residential occupation. The dwelling unit is described as a self-contained unit that has facilities for living, sleeping, and the preparation and consumption of food. Check, check, check. They are a residence. So I would ask, number one, that the board classify the second floor appropriately as residential, which is one of the items of contention on our application. What value do we apply? Well, that's the next big question. So we've gone through an income approach to value, as the assessor has done, and we've looked at a set of comparisons. Now, this is difficult because it can't be used for a typical office. It should be a medical office. And when you say medical office, that's a term that typically implies doctor offices, dentist office, etc. And you're going to find 95% of the time, those kind of offices are located in high traffic commercial areas, certainly with sufficient parking, sufficient access. If it's a multiple floor, you're going to have an elevator. The subject property doesn't have these items. So it's very difficult to find appropriate comparisons. In any event, on page 16, we've gone through 12 comparisons, and many of these are very similar to what the assessor has submitted, and I will talk about those in rebuttal. But I'll summarize it as this, Mr. Chairman. Most of these comparisons are commercial doctor, dentist type offices. They would command more with the parking and everything else that they have than something like the subject property. The average of my comparisons is $17.39 a square foot. I mean, even notwithstanding that there's no elevator and limited parking, it's still assessed considerably higher than these comparisons. The comparison I think I like the best is number 1, and that is 1218 Lorette. On page 17, I show a picture of a typical comparison of the others, strip malls and offices, or mostly strip malls in my case. And then I have 1218 Lorette. It's a very similar circumstance. It's residential location. It's actually not far from here. And it has wheelchair access up the front. And the main floor, one of the tenants is leasing for $15.54 a square foot when we net it down from the gross. And that's actually very close to what was applied for the assessment as well. That is a good comparison. So based on that, I would think that the subject property should command no more than $16 a square foot for the main floor. Now, we would have something lesser than that typically for the second floor because it doesn't have elevator access. But again, the second floor, we're going to ask that we treat as residential. So it's just the basement that we need to look at next. So on the page 18, we look at 3 comparisons of basement space. Typically in the market, you're going to find a lower rent per square foot on basement space, especially if it doesn't have elevator access, and especially if it doesn't have proper fenestration. These 3 comparisons average around $6 a square foot. We've applied a slightly higher rate of $8. So we have $16 on the main floor, $8 on the basement. And that's actually consistent with what Altus often does with basement spaces. So rent half as much as the, if it's finished, rent half as much as the main floor. Then we'd have no contention with the vacancy allowance. Again, the vacancy concern upstairs, if we treat it properly as residential, we don't have that concern anymore. Shortfall rate, no concern. Non-recovered expenses, we again ask that the 7% be applied instead of the 2%. And capitalization rate's the last one. We do not think that 5.5% is appropriate. There's no evidence to support something as low. And if anything, this property has risk upon risk of trying to attain the incomes that we're applying. So we've done a cap rate study, and I'll save some time. We do look to the broker reports. They are marketing reports. They're not to be relied upon necessarily, but just to bring a point home that I mentioned in the questioning, even the brokers suggest that suburban office would start around 6.5 and move up to about 7.5%. On page 22, we did have some comparisons for office capitalization rates, and three of those would be considered comparable in location, more of a suburban location. One is actually on Warsaw, not far away. And the cap rates for these properties are consistent with what we see from the broker reports. They range from 6.5 to 7.2. And so in conclusion, we would not accept 5.55% as the capitalization rate on this property. We would ask for something at the low end of the broker reports, but say 6.75. That's basically at the low end of our comparisons as well. So those are the two main contentions, is the market rent, which when we look at more comparable properties is something less than what the comparisons show, and certainly less than what it's currently assessed at. And the second is with the capitalization rate. That brings us to the second floor. Now, we've looked at comparable rents for newer construction, and that's at the top of page 23. And we find that these units command between $1,200 to about $1,500 per month. And we've used the high end of that, $1,500, but again, no elevator, pretty basic unit in the end. And it's 1,650 square feet, so you got a lot of area. I mean, she just moved in as a big space, but I mean, if this is on the market, this is very atypical. In any event, $1,500 is what we've applied. We use typical multi-residential rates of 2.6% for the vacancy allowance, expense ratio at the lowest end, 35%. We would then have a net operating income of $10,998. Just as a note, if we value this as office with a lower per square foot rate, we wouldn't be far off on the NOI. So the value isn't far off. It's the classification is the main point. We do capitalize residential lower than we do commercial. So in this case, we actually apply a lower capitalization rate than the city of 5.25%. And that's based on an excerpt of our study at the bottom of page 23. So the resulting value of just the second floor as residential would be $209,500. So on page 24, we summarize. We have the medical the office on the main floor and the basement that we valued. And the value of those two at the capitalization rate of 6.75% comes out to be $496,770. We add to the second floor residence. We ask that the classification on this section be class code 10, and that value is $209,500 for a total value of $706,000 rounded, divided into the two classifications. I have excerpts from the deliberations by the council on the variance for the medical office included at the end. And that would complete our presentation. Thank you, Mr. Chairman.
You want to do your rebuttal right away?
Sure, thank you. If you refer to the rebuttal evidence, it basically is reiterating what I mentioned before, that I question if these type of comparisons, there's really 6 properties that the city's used and multiple units in each. And I thought pictures speak the best for these. 400 Taché is a medical tower, obviously elevators, etc., and ample parking located right across from St. Boniface Hospital. That's not at all like the subject property massage clinic. 1020 Lorimer is even more so. It's one of the premier office, medical office towers with ample parking. And then the others are all in commercial locations on Pembina with ample parking, on Roblin, St. Mary's, and Portage. These are kind of retail, commercial locations with ample parking. They're fine as comparisons, but we have to recognize that some adjustments are required compared to the subject that has 5 stalls in the rear and no elevator access, and not in as high traffic as an area. That's it. Thank you, Mr. Chairman.
Any questions?
Yeah, sure. Just touching base on the comparables. Yes, there's no hiding the fact that those are what they are. But given the subject property and what we've discovered through discovery process, it is owned by Symmetry Massage Therapy Incorporated, correct?
Mhm.
There is obviously a chiropractor of some kind or massage therapy of some kind going on in the property that's suited for that type of practice, correct?
Yes, the owner is a masseuse. She practices there.
So that is the nature of, but given the physical, I had some reservations when I was reviewing this property. Like I said, part of this is discovery. Can you please turn to your page 8?
Yes.
So this is where it's physically located. It's located just off of Donald. Good visual from Donald. We have on page 10 showing the massage rooms, correct? Well, not quite massage rooms, but we see that there's long corridors. There's rooms that could be used for, your therapy rooms. We see the main floor area. We see the reception area. It is pretty standard, correct?
Correct.
Okay. So then we get to the second floor. We see a second floor that's OSB subgrade flooring. We see the wall finishings done, and we see a mat, a couple couches, table. Looks like there was a sink put in.
Yeah, she put in a kitchen island area with a sink and the plumbing and such.
Would this not simply be, and I understand what she's done. She had an apartment, she can't afford both. She moved into the upper floor. But would this not be simply vacant, whether it be office space or medical office space?
Based on the definition of residential 1 in the classification, I think this sits in the definition, and I mean she's occupying it for residential purposes.
This wouldn't be suited for such and wasn't designed for as such, correct?
Well, I mean, she's living in it. I think it's suitable for now that she has the facilities put in.
So was there an occupancy for this? Was there anything granted for this use?
Well, she didn't need it. It's a residential zoning.
So when we're looking at this, would this simply just not be an owner of a property, small park property, trying to mitigate losses from the start of things by simply moving in there for a bit? And if she could get a lease, small or whenever, would she not simply be ready to move out?
Well, I guess, yeah, she could get a lease for this space. She'd have to do the math on it and figure, is it worth me now trying to find another place to live, et cetera. I don't like speculating, Mr. Pohl. The fact is, based on the regulation, this fits the definition of Res 1. She's occupying it for residential purposes.
Realistically, the sense of realism. This is simply an office space, for whether it be converted to medical or whether it be converted to a regular office type space. It's simply unleased, and she's trying to mitigate her losses, right?
She's definitely trying to mitigate losses. She can't lease the second floor, and so she's trying to mitigate losses. You're right, but I don't think the Act talks about intent. It talks about what are you using it for, and is it capable of occupancy as residence? She's occupying it for residential, so I'd suggest yes.
Still currently listing it. Is the owner still currently listing it?
I don't believe so.
Still actively.
Well, I shouldn't. Actually, that's a good question. I assume not, but I can't assume that, so I can't answer that.
Mr. Hutchins, any questions?
Yes, thank you, Mr. Chair. Mr. Slaughter. So I'm looking just to confirm that the owner is using the second floor as a residential, but according to Mr. Pohl's evidence, it's being listed as for lease as a commercial space.
It had been listed since they constructed it by Mr. Roswell as commercial space, and as I mentioned, they've had very little interest, or the one interest that they had couldn't occupy it because it wasn't a medical purpose.
So just to confirm, the current owner is going to occupy the main floor as a massage therapy space. Then she would have been trying to lease the second floor. Is that right?
Yeah.
Okay. So I'm looking at the variance order that you submitted. in your brief on, where are we? Okay, kind of towards the end there, Rod. And it says that the development shall be built in substantial conformance with the plan submitted and attached to this application. So it was submitted, the variant was allowed for commercial use only construction.
I think,
Am I misreading that, or?
yeah, no, I've talked to her about this, and my understanding is that it's owned residential, so she could use it as residential, but she needed the variance in order to have any commercial and restricted to clinic activity or occupancy, sorry. And so I asked that exact question. Are you allowed to have the second floor residence? She said, yes, it's zoned residential still.
Yeah, except the way I read the order, the variance order, is that it was only allowed for the construction of a commercial building and commercial usage. So I don't want to get into whether she should be up there or not, but that variance seems to say that it was granted only as commercial use, in my opinion. And I'm wondering, was that when it was built? Was that a house on there that was demolished?
Yeah, it had to move, damn it. Yeah.
Yeah. Okay, it was. It's on that lane, right? Okay. Yep. Yeah. So it was zoned, and then she went and, I don't know about this second floor, whether, boy, I'm reading that variance and it's like for use for commercial use, the whole building.
I have to admit, Mr. Hutchings, it was exactly my question. I said, you should be residential if you're occupying it, but are we sure that all the T's are crossed here and she said, yeah, she was confident. So I can't answer your specific questions about the language of the zoning. I guess here's my point though, Mr. Hutchings, is that if we don't consider it residential, we have to get back to the point of why she's up there, is that because of the restrictions on the use, the lack of elevator access, et cetera, they can't get a tenant. So how do we value this? Yeah, no, I know it's a little bit of an oddball, all right. Yeah. It certainly is. It's one of the strangest properties I've worked on. But Mr. Pohl did present evidence of Roswell trying to lease out the upstairs floor. Is that right? Oh, yeah. Yeah, they've been trying. That's why I got the phone call on this property, is that he said, my client's having a hard time. I've been trying to lease this and I can't. Their taxes are high. Can you help? And since then, it's been this kind of interesting. And when you did this, I'm looking at the split of class code 10 and class code 60. It wasn't a matter of splitting the square footage. It was a matter of, how did you come up with the split? You just, that's a good point. So I could have valued the second floor. In fact, originally I was going to value the second floor as commercial. So I mentioned I had, a lower per square foot rent. You run it through the calculations and the value wasn't that far off. But then I thought, I'm going to come before the board and they're going to say, what are you doing? Is it commercial or is it residential? And my answer would be, well, it's residential. So why didn't you value it as residential? So I went back and I redid it as a residence. So to answer your question, it's not based on a proportionate share. It's based on the value hypothetically contributed by the income streams of each. Yeah, okay. And I guess my last question is, rather than do it on the income like that, would it not be considered a condo up there? Would that be fair? Yeah, I guess it could be. If that's allowed. We'd have to separate title. I don't know if I'd go down that. It's an interesting point, but I think that might open up a bit of a can of worms if I went that route. Okay. I believe that is all my questions. Thank you very much.
No, I'm good. Thank you.
Even with a residential, you have to have an occupancy permit, correct?
She has an occupancy permit. My question was, based on this variance order, it's exactly what Mr. Hutchings was asking. And she said she's fine.
She says she's fine.
Yeah. I didn't want to come before this board if I was.
Did she put a kitchen in? Did she get a permit to put the kitchen in?
I can't answer that.
It's plumbing and electrical, so she should have pulled a permit. Did she put
and she may have. I don't know.
She put a bathroom in with a shower and a tub?
No, there's already a bathroom. There's multiple bathrooms on Main and Second, so she uses those.
Is there a bathroom with a tub or a shower?
With a shower. Bathroom with a shower. She's quite comfortable there.
So I'm not knocking whether she's comfortable. I'm saying, did she install a shower upstairs without a permit? Yeah, no, not upstairs. She's using the shower that's already in the building. There's main floor washroom and downstairs washroom with showers. if you want us to make the upstairs a residential, it needs to have a shower and a bathroom to be a residential. And she needs a permit to do that.
Yeah.
And she needs an occupancy permit.
Fair comment.
So she's got to go to the board, a different board, or at least the planning office and pull the permits and pull the necessary paperwork to make it residential.
Yeah, and I can't say if she has or hasn't, Mr. Chairman. I don't know. She said that being zoned residential, and she has an occupancy permit for the building, so I didn't push it much further than that. So in any event, this is a big question. Should we be classifying as residential or not? In my opinion, we should. But if not, then how do we value it? I think the value still, as I mentioned, is fair considering the difficulty they have with that second floor.
2017, never been occupied.
That's right.
What was the vacancy rate you gave them?
We're just using market because I'm saying if I'm taking the residence or the second floor out as residence, then I'll apply market vacancy. Yeah,
It's on page 4.
5, eh?
yeah, 5.5%.
But if it hasn't been occupied as a commercial since 2017, correct?
Since construction. That's
First
right.
floor or second floor has never been occupied.
It's never been occupied.
Yeah, it's a newer build, like so
So wouldn't that be like almost a 50%?
well, it'd be startup vacancy, and plus it was never, from what it looks like, it was never finished. It looks like it's shell space, even the flooring is just.
Right. I'm looking at the picture.
You can see it.
Yeah, so, and that's my conundrum, Mr. Chairman, is that, I mean, if it isn't residential, because of the realities of why she moved in there, how do we value this? And I would stand by the value I proposed, but I mean, if I was to sharpen my pencil on a commercial basis, they have a difficulty here. Restricted use, restricted access, restricted parking.
Not residential.
Only medical clinic for commercial use. Now, the question that Mr. Hutchings said is, does that mean it erases the residential side? And in my opinion, I didn't think so, but it's a question. I don't know.
So if we're trying to get us, my conundrum is if you're trying to get us to deal with value alone, because we can't deal with the classification.
Right.
Not in my books anyway. We'll have a discussion on that after, but I don't see how we can deal with classification. And you're trying to look at a number. So we can't use your paper to give us a number because you changed it to res without really changing it to residential.
Well, as I mentioned, Mr. Chairman, the value that I applied on the residential portion was similar to my income approach if I had used $12, et cetera, and not even counting vacancy issues. So I would stand by the value. I'll leave it to the board to decide if they want to split the classification.
Yeah, but your value includes the residential portion, is what I'm saying.
Right, and that's the residential portion, the value is very similar to how I would have ran it as a commercial space. 210,000 is the value. That's not far off from how I would have valued it as a commercial space. Unfortunately, I don't have that in front of me, but I'm suggesting that based on the market evidence that we've seen, that this would be, and the realities that this is difficult to lease, it would have a lower value certainly than the assessment.
So you're putting a value of $12 a square foot on the second floor.
I had originally, yes. And I would have had a slightly higher vacancy allowance, everything else the same.
I've got nothing further to add. I guess we'll have discussions on it after. Thank you very much for your presentation on that one.
Thank you.
And I guess the next one we're going to deal with will be 365 Osborne. Is that correct? Number 7. Is that Rod's as well, or?
No, that's Jared.
No, that's Jared.
Okay. We're going to put you back in the box. Are you all done now, or?
I think I'm all done. So thank you very much. Nice
What about
seeing
number
you.
8? You got number 8, don't you?
1001 order. Is that what
No, actually, it's just a confirmation, Jeremy or Michelle. Can I just confirm that now, or Mr. Chairman?
I guess I can go to that one and we'll let you confirm it.
Okay.
Number 7, so that'll be the 101 Corden Avenue, correct? 1001 Corden Avenue.
That's correct.
You guys are both agreeing on confirmation on this one?
Well, he's asking me to be confirmed, so I haven't, don't change it, so, yeah.
You got no. Okay, you want to present your evidence then on it, please, Jeremy? Keep it short, keep it brief. Read the title on it.
Yeah. Bear with me here, guys.
Yeah. Do you have the paper on it?
Pardon me?
Do you have the paper on it?
No, I thought this one was gonna be full, that's why I left it, but I have it here, so we can screen, I'll squint in.
You have paper on everything else.
Okay, all right, our roll number is 12097626 address is 1001 Corden Avenue. There is a 2022 assessment of $6,138,000. We're recommending that it be confirmed as per the agent. The building was built in 2007, 2008, so it's traveled 2 years. Gross floor area is 25,000 square feet. Leasable area is 23,431 square feet. It is a 3-story building, and there is some parking on site as well. If you turn down to page 11 of my brief, shows where the property is located. It's on the in there. Stradbrook's just across that tail end there is Shoppers Drug Mart. So if you know the Shoppers Drug Mart is, that's right where the location is. So the building was built for and was occupied by Winnipeg Regional Health. I believe they are now out of the property. The leases that were in place for the Cisco market for the net rent that they had was about $20.19 a square foot. That would be on page 18, highlighted in blue. And there is no vacant spaces that we have in there. Comparables that we're using are on page 4. This is for, sorry, got ahead of myself there. Comparables are start on page 3. For the C2 space that's in place, we have an average of $15.70, weighted average of $15.72, and median of $15.55, or very tight analysis there. For the A1 space, we have the medical space that relates to the space. We have an average of $21.42 a square foot, weighted average of $20.87, and a median of 22. So we got a nice analysis there as well, very tight. And then we have the Winnipeg Regional Health. Winnipeg Regional Health was occupying it. They're no longer, from what our records indicate, but they're not related. I'm not sure if the doctors are in place or Julie. I'm not sure on that. So what we have now, we have the space for wherever Winnipeg Regional Health is located for the Winnipeg Marketplace. We have an average of $18.29, weighted average of $18.96, and median of $18.80. So for the CRUs that we have in place, that sisters our analysis from the marketplace, and the average that we have is $17.92. Applied to the 22,430 square feet of leasable area gives you a potential rent of $420,000. Our standard parameters attached to that: vacancy at 5.5%. This is a gross income of $390,000 approximately. Expenses at 2% and shortfall at 7%. Gives us a net operating income of $380,126. Cap at 6.55%. Gives us $5,803,000. And then the income stream for the parking is on the next page. It's just 31 stalls outside. So $60,000 gives us another income stream. And that's what you have on the summary page, page 8. I believe there was going to be some contention whether the class of liability for Winnipeg Regional Health, which was there, there was a large series of wheels which we've adjusted on the Winnipeg Regional Health space. This one wasn't done. When we looked at it, it doesn't appear that they're still in the space. We've given an exemption as well. So that said, that's our analysis. So with that, I guess I'm open to questions for.
See if there's some questions, or if you, Rod, you want us to just confirm?
Yeah, just confirmation, Mr. Chairman. There's no contention on value. It was a question of classification liability, as Mr. Pohl had mentioned. But I think the tenant's agent is taking care of that directly with the city. So we're just going to ask for confirmation.
Thank you. So we'll take care of that.
Okay, thank you.
It'll be confirmed.
Thanks. Good afternoon, Rod.
Have a good day.
Yes, thanks very much, everyone. Take care.
All in. Yeah.
Hi, Jared.
Hi, how are you?
Good.
Good, thank you.
Okay.
If you're ready, we'll get going.
Ready to go?
You ready? This will be file number 7, correct? 365 Osborne. Jeremy, when you are ready.
Oh, I need to swear you.
Oh, that's right. 1 second, we gotta get you sworn in.
Can you state your full name, please?
Jared Story?
Do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth?
Yes.
Thank you.
Jeremy, when you're ready.
Phone number is 120976 37300. Civic address is 365 Osborne. The 2022 assessment is for $15,149,000. That is based on a board order, which we're paying deference to, which is on page 23. This was appealed in 2020. The board reduced it from $15,611,000 down to $15,149,000. That was based on a capitalization rate of 6.75%. So, and then our net operating. So we're basically maintaining that, and I'll go through analysis now. The building was built in 2006. It's 2 stories. It has approximately 76,282 square feet. It is a 1 occupant building. We look at on page 8. Just off of Osborne, there's a co-op and there's a McDonald's in front of it. There's good access to just set off of Osborne. So there's ample parking on the building, on the property for the building. On page 10, it's classified as far as Artist Reed is concerned, a call center, and it is. Pictures are there on the next page, page 11. I have no interior pictures of the property. So. The next 2 pages over, we have a rent highlighted in yellow. We get approximately a little over $1,044,000. The recovering management fees. There's some issue there, whether non-recoverables, again, they're recovering that. The non-recoverable costs are approximately $7,400. So again, fits in nicely with what we're saying. As far as a 2% allowance. There is an appraisal fee. I'm not sure what that's for. Highlighted in yellow on page 16. On page 17, we have a start date from 2007. Lease goes to 2026. We have currently, they're in place for $13.75. And so you see the step ups as per, but again, we are taking leases that are paid. Those are future projections that may or may not, events that may or may not occur. Less weight is given to them, even if they're known. So We look at on page 18, we have the total area what they're declaring, 75,986 square feet. So there is that. We go back to the analysis we have for OFSs. We have on page 3, we classified it as an OFS, 3 comparables. They are all outside the downtown area. As you see, before the 5,000 square feet, we have an average of $15.19. We had an average of $14.73, and we had $14.72. So again, difference into good analysis. Next page over, we have our actual marketplace valuation. We have for the leasable area $14.89. Apply to it, which gives us a potential rent of $1,549,849. Leasable area, like I said, 76,282. That's right there. Vacancy at 5.5%. Gives us an effective gross income of $1,073,368, or 2% expenses, which sisters what we see in the we reported, I should say, from the financials. And a shortfall of $7. We get a net operating income of $1,022,532, capped at 6.55, gives us our income of 15.6. But of course, we have the adjustment, which is the total itself, which is 15. With that, it's a pretty straightforward analysis on the questions.
Questions? Derek?
Yes, thank you. So, Mr. Pohl, have you inspected this property?
Wow.
Okay. Have you reviewed any images of the interior to determine the quality of the build-out?
No, I don't have any on file that I'm aware of.
Okay.
I just know what we have on the artistry website.
Okay. But can we agree that the property was purpose-built? It was built to suit for the purposes of functioning as a call center?
Oh, yes, very much so.
Okay. And then can we also agree that the quality of the build-out in a call center would be vastly different than what we would see in a more typical professional office building? Are you agreeable to that statement?
Tenancy, yeah. You need more floor space area. It could be more of a headquarters type office place, similar to 225.
Okay.
But I mean, if it's more multi-tenanted, then yeah, I'll agree with that.
Okay. And this building is somewhat unique in that it's 76,000 square feet and it's single tenant, single premise. Would you agree with that?
Yeah.
Okay. And just a slight discrepancy. You're using 76,282, but throughout the rest of your brief, you're showing that the owner is reporting 75,986 of leasable area over two floors. Is that correct?
Yeah, that kind of variance I wouldn't typically change.
Okay.
We have that in any office place from INE to what we have on our premise ID.
Okay.
With an exception.
But we can agree that it does change the modeled rent if we adjust to the actual reported GLA. It does change it slightly. Is that fair to say?
1% yeah.
Okay. Now, page 3 of your brief includes 30 rent comparables. I've reviewed all of them. Were these comparables selected specifically for the purpose of this exercise for this property?
No, they're a standard OFS workup that we have. I'm sure it's been used by myself and other assessors as well.
Okay. So in your mind, are there any specific comparables in that list that would be more comparable that we should put a particular focus on?
I'm simply bringing in the marketplace and what it's paying per square foot. If you're asking me, do I have another 75,000 or so square foot call center? No, I don't.
Okay, but just to be clear, comp 8 on the sheet is the subject property, correct?
Correct.
Okay. And the lease included in that study for the subject property is the lease rate that we are applying of $13.75. Correct?
Yeah, correct.
Okay. And index 14 and 3, those are both also call centers, are they not?
Yes, I believe.
Okay. But ours would be larger. Now, I guess my question is, do you consider economies of scale when you're looking at developing an appropriate rental rate for a property of our size versus some of these much smaller rental indices that you're using?
Economies of scale is a theory. You'd have to have a numerous comparables in order to properly test that.
Okay.
Typically, as you go large, it depends also the use of the property. Car dealerships, for example, you would expect to get a larger rent per square foot as your dealership increases because you have more economic opportunity on that site. So it depends on the building as well. But in call centers, it would be typical office place. You would expect that to a point would decline, but once it reaches a certain point, it wouldn't go below that.
That's interesting. So I actually removed the entries under 20,000 square feet on your study, and we come to 1380 per square foot, which is sort of interesting, but that's fine. Just two that I wanted to focus on. Number 3, again, that's another call center. It is smaller. It's only 18,000 square feet, but and I think this has been submitted to you in the past, but the rent that you're using here is $16, but the actual rent is $13.30. And I think, can you agree with me that I think this has been presented to you? There's a $2 square foot on 3,500 square feet of mez space that wasn't initially applied, and the actual rent over those two premises is $13.30. You're aware of that?
You may have presented it to me. I don't recall it at this particular moment.
Okay, fair enough. And similarly, indices 26 on Wilson. This is one I had the same error in my brief, but it's there are 2 units there, and I think we've both missed them in our initial submission, but it's not 1278, it's actually 1075. Are you aware of that?
Sorry, which company?
That's number 26 on Wilson. So that's a consulting firm. They actually have
24/6 is 1380, 1345.
I'm sorry, 25. My mistake. Yeah, 25.
1558 Wilson.
Yeah.
That would be, I want to say Dylan, but it's probably not Dylan.
It is Dylan. Yeah, no, that's correct. Yeah. Yeah. Okay, so that one is 1075. Okay, so that's fine. So we're really only concerned with the non-recoverable issue and the rents. So I guess my question is, when you're applying a modeled rent, do you think that the actual contract rent in place, which you've included in your study here, is perhaps the best indicator of market for this space?
No, you always test market against, you always test market independently against the contract, and then you determine what most likely would be. We have a 13.75 cent rent that was established in 2006. These are not renegotiated as per market, and neither party can walk away from them. These were established in 2006.
Right, but
it's increased since then. So I would say no, based on that, it wouldn't be.
Okay, but I've heard you say a number of times throughout the hearings this morning that the owner is a very savvy player in the Winnipeg real estate market. Do you think that they'd be accepting a rent that's below market for a property of this scale?
Even the most savviest business owner, property manager, really can't predict from 15 years out what that marketplace will be in 15 years in relationship to the current marketplace rent that they
Okay.
So that's getting to 2 negative extremes. If I could predict that out that quick and that accurately, I probably wouldn't be sitting here.
Okay, that's fair. But if we look at your some of the rent comps, then if we look at, for example, 24/7, which is another call center, and there are only a few call centers in this study, if they're at 1330, does that not support our 1375 for our study?
Yeah, but that's also, those also aren't the same quality of build as this. The one over on Taylor was, I believe, in whole bank space. Not really as suitable as the one that we're looking at now. So the level of finish, the quality of build, this is a superior product to that.
Okay, but you've not been inside the subject, so
no, but I can,
assume
from the plans, from what's and I would appreciate a bit of pictures in your brief as well. But from my understanding and from what the artist portfolio is they do not acquire lower grade property. They acquire investment grade property, and this property fits that. It should be at an upper end.
Right, and we can agree though that this property was built to suit based on an RFP issued by the tenant, correct? So it wasn't
Yeah.
acquired; it was built, right? And it was built in a cost-efficient manner by all reports.
Yeah.
Okay, that's fine. Now I'm just looking here in your brief on the assessor or on the owner's marketing page. I believe that's page 10 of your brief. It does mention that this lease comes up in 2026. Do you think that if we're projecting into the future, do you suppose that if that tenant decided not to stay, that would cause a great deal of expense to the owner in terms of either redemising it for multi-tenant or for attracting a new tenant to that very large purpose-built property?
Are you saying for a hypothetical vacancy? Absolutely, but again, that's a point that hasn't been known yet. At the same token, we can say that we can assume that they could renegotiate another 30-year lease at a higher rate.
Okay.
And that it's a site built, and they could move outside of this property and find a better suited utility property that gives better utility for what they do in the marketplace. We can play either way of that, but I would say that we shouldn't be working from post-reference information or hypotheticals.
Okay. Now you've included the most recent decision. Now I think it's probably been heard a number of times that this is a de novo hearing, and that's our position, is supported by the municipal board. But I do notice that in 2018 there was a recommendation at the board for $12,642,000. But the value that's being suggested today is almost 20% higher. Is there any change in tenancy or physical configuration of this property that you think would give rise to a 20% increase over the last cycle?
We're not basing an assessment. I think the board made it very clear we don't compare assessments from one to derive an assessment from one cycle or the next, or components from one cycle to the next. So when I come into a hearing, I don't review what was done the cycle before, the cycle before that. I don't base my opinion and value on the assessment. I base on marketplace facts. So,
But you did include the decision from 2020.
2020 is there because this is a frozen year. We're respecting the board's decisions on all 2020, unless there's a grave error or something really wrong. We're respecting the board's decisions and we're moving forward and applying them now. Even if we have a municipal board order or municipal board appeal filed on a property, we are still paying deference to the order that the board revision is given. So this is why this is here. I referenced that. The board made the decision and we're respecting the board's decision.
Okay, thank you very much.
Not comparing assessments, that's issuing an order that's already been done. And it's kind of a weird scenario given COVID. I don't think this has ever happened before, so that's why it's there.
Okay, thank you very much. Those are my questions.
Mr. Hutchins, any questions?
No questions, thank you.
Robert, any questions?
No questions, thank you.
And I've got no questions. Let's move on to your presentation.
Wonderful, thank you very much. And Mr. Chair, I did supply inspection photos. They were supplied to the board. I'm not sure if you all have them, but if you'd like to peruse them, it's supporting the fact that this property is indeed built as a call center, great deal of open space, and a very predominant lack of actual offices. So that's mostly cubicles on an open floor space. Over the 2 floors, there are 8 offices per floor. So those were provided to you based on an inspection that I conducted on September 22nd. So they're very, very recent. So again, thank you for hearing this, our position today. We have 2 main points of contention. So the 2 issues that we'd like to articulate revolve around the modeled rents. We believe the modeled rents appear too high based on the contract rent, based on the fact that this property is indeed a call center, and the rental rates for call centers are clearly lower than the rental rates for what we'll call more typical professional offices, and that's based on utility primarily. We will also request today that the non-recoverable expense allowance be reinstated. Now, I'm guessing that from Mr. Slaughter's presentations to the board that you've heard a fair bit about the 5%. But if you'd like me to articulate that, I'd be happy to. Pardon me?
You don't have to replay it. We've heard it.
You've heard it. Okay, wonderful. Okay, so you're aware of our position. So we do believe that the rent in place is the best indicator of market value for this property. And that again is $13.75. This is supported by our comparables and indeed by some of the assessors' comparables as well, particularly the larger properties and the ones that are more typically used as a call center. So again, we're using $13.75. I've included some comparables here on page 8. I'm happy to go through them with you. I think the ones that I'd like to concentrate on would be on Waverly. Waverly is a good comp. It is used as a contact center, though it is much smaller. The rent at $15.50 by economies of scale support are $13.75. Number 14 Fultz Boulevard. I think that may be my best comp. There are 2 buildings on this property, but they are distinct from one another. And there's one large space that is used as a contact center. Now it is quite large, and it's at $10.09. So again, we believe that supports our $13.75. We've both used 850 Pembina. Again, I think that's likely a superior location. It is smaller. So again, we believe that supports our $13.75. I suppose that the rest of my presentation was focused around the non-recoverables, but if that's been asked and answered, we are effectively asking, yes, that the 5% be reinstated to 7%, and that the modeled rent matches the contract rent at $13.75. So with all of those points taken together, we come to an estimated market value at the reference date of $13,201,000. And we do respectfully submit that the 2020 assessment or the 2022 assessment ought not to exceed $13,201,000. And barring any questions, that is my presentation. Thank you.
Jeremy, questions?
All right, to start off on the non-recoverables. What is the non-recoverables actually at?
Okay, so the non-recoverables are you saying at 2017?
Yeah.
Right, so the 20
line, I'll just guide you to there, 65.95.
Sure. So okay, let me just pull that up. So this is outside of the straight line rent depreciation. I think we probably talked about that earlier. But if we look at what they're claiming as non-recoverable, you've highlighted it in your brief, and we have it here. There's the appraisal fee. So they have it as $11,603. Now, what's interesting though is in different years, the non-recoverables may be higher, and in some years they may be very low. We're certainly not looking to say that in every single year of the property's effective useful economic life, that there's going to be a 5% erosion to the effective market income based on non-recoverables, but rather stabilizing that allowance over the useful economic life of the property. Clearly, in the competent management and ownership of commercial property, there will be expenses that are not recovered. So I think I know where you're going. In this scenario, they would be lower than what we are looking for, but I think that's outside the point. As a large evaluation issue, we do believe that the 5% stabilized over the useful economic life of the asset is reasonable.
So basically, when I do my analysis, it's 1.1%.
In this specific
stabilized over the years leading up, it's typical.
Right,
So,
and we have provided a study, and I know that this has been.
we're not doing the study right now. We're just doing this. So,
Okay, well that's for 1 year. That's for 1 year, and that's not
if you look back over
stabilizing.
the number of years leading up, is that typical that it's around 1%?
I have not looked back on the last number of years in this property, so I could not answer that. I'd have to be speculating. I wouldn't speculate on that without knowing it. And we did mention into the future that there may be costs associated with redemising the space or marketing this space or the leasing commissions. But again, that would be
And the leasing commission and marketing and stuff like that is below line items that wouldn't be inclusive of the net operating income. That would be below of the net operating income. So it's a cost that we're not determining the capping and net operating income. That seems to be Altus's and other agents' positions, but pulling that back up and in. Just pointing that out, we don't have to belabor that point, but we're awarding 2, you're asking for 5, so or 2 and 7, depending on how you're looking at it. Okay, so the subject property, if it was built to suit, correct?
That's correct. Yes.
Site utility for the specific use of the nature would be